First of all, thank you so much, sir, for coming on the podcast with us once again and helping us understand a little bit more about the markets. This, I mean, ever since the first podcast we had, and even before then, I have been a fan. Uh, you are a complete all rounder. I don't know how many talents you have. I don't think, honestly, nobody has been able to count that, I think. But once again, thank you so much for joining us. And I think generally how we generally do it is I have few of my questions, and then we take up public questions, and that's how it happens. But Aj, already we have been flooded with so many questions from your followers that I think I it's better to give them precedence and just start with them. uh, of course, let's start with in general, thoda sa your view on markets, and then we'll take up directly their questions, maybe, sir.
Yes, first of all, thank you for such a lavish introduction. I don't know whether I'm worthy of it, but a person is only worthy of what his followers make him. So I'm very grateful for all the followers that I have, because it is their combined love and affection that basically directs me here. Now, as a standard thing, before I give my views, I'm these views are only personal views as an investor, and I'm not a registered SEBI advisor. So please, include that in your understanding. So, the interesting part of everything is that since the month of February, as I have been talking on Twitter, as also in some of my TV or Spaces talks from February, March, April, May, effectively, I turned negative on the market. Now, negative on the market does not mean I sold my portfolio, but I did not, I moved away from buying simply because there were a lot of problems that had come out in the world, which most people are aware of. But I had also said that I would like to see the behavior of the retail, because the retail had not seen a drawdown in the market, and it was very important to see how their behavior was to pan out when the market returns were to turn negative. So what happened is that in the February to May months, by avoiding the fresh purchases, or by sort of not doing much in the market on the bull side, you effectively were able to somewhat insulate yourself from the market fall, which was quite severe. But then what happened is the market at that same point of time, there were many measures all around the world to tackle inflation. Almost every country's government was became very adamant about taking steps, and India was taking steps, and certain measures were taken by the Indian government which were peculiar to India. RBI statements, which turned very bearish during the earlier months, started saying that now inflation is likely to moderate maybe by September or October. Now, typically, market reacts 3 months before something. It's like corporate results, or whether you see corporate results, whether you see announcements, whether you see budget preparations of the market, etc. So, if you take September or October, that is the ninth or 10th month, and you minus 3 months, and you're effectively talking about the sixth or seventh month, which would have made it June or July. Also, what had happened is there was excessive selling, unprecedented selling by FIs, and at some point of time, the selling had to abate for multiple reasons. One, that the effect of inflation. Two, the effect of crude had started correcting in a meaningful way. Commodities were correcting in a meaningful way. Third, that one of the sectors which actually has the potential to lead the market, and I've been talking about that for some time now, which is the financial sector. The NPA ratios, or the NPAs, have become relatively low. Even today, Standard and Poor had put up a statement that this will be a very low NPA for banks. And credit cycle has to uptake, because what happens in adversity, there is opportunity for somebody will do acquisition, somebody will do capex at the cost of something else, somebody will have the money to do, like Reliance, for example, was making acquisitions at the time when the sentiment was lower, right from the COVID time, etc. So there'll always be an opportunity. And the fourth or fifth most important point was that the correction in the mid caps and the small caps was very severe, commensurate to the problem, because most of my thought process was that some of these problems may be a quarter or a two, which also 2 quarters would have also meant a lot, but the market had already discounted a large part of that by the corrections. And when I'm talking about these mid and small caps, I'm not talking necessarily about new age companies. I was talking about very credible businesses that had corrected substantially. So what happened in June, as an example, was that I had a screen in front of me, and in the screen I would see scripts, And for 1 second, if you were to switch off your mind from the market, you look at those scripts and ask yourself, do I have a reasonable probability that I will make 20% returns for the year end? Now, if the answer was yes, then it was a blind buy, because 20% in 6 months means a 40% annualized return. If the answer was not 20 but maybe 15, then also it was very supportive because it was a meaningful return. So I made a list of scripts in the mid cap and the small cap sector which I felt were very attractive, and from the month of June I have been aggressively buying. And I had also indicated in some of the chats that I believe that the large cap index will underperform compared to the mid caps, which was against the consensus view. The consensus view was large caps will do better and mid caps and small caps will do lesser. So now you've had a situation where, for example, the market has done, if the market has done 4.5 to 5% on the Nifty or Sensex, the mid cap index is up some 11 or 12, 11%, and the small cap index is up some 12, 13%. But on a relative basis, a lot of small caps have rallied more than 20 to 30%. Some of the names I shared on Twitter. So the real fun of what I was trying to tell you, that at the end of the year you're going to make your 20%, etc., has already happened effectively in a month. What is now happening is that the global situation is not getting worse, because it is like on a status quo. There is a impact that has happened on the gas prices in Europe, and for example you heard Germany saying that they will cut output by 15%. And I feel that some of these cuts could again be an opportunity. Again, the same theory of adversity, opportunity and adversity. For example, I believe that a sector like, as an example, chemicals could see a second round of a rally, because some of these are inevitable global businesses, and the shift, which you called as China plus one, now you want to call it the switch away from Europe. There are a lot of these businesses are essential to the functioning of manufacturing in Europe, etc. So there are opportunities there. In between these months in February to May, in order to safeguard ourselves, I had suggested one, to be overweight on banking, and I named a few stocks that I personally owned. And secondly, I had told you that the MNC manufacturing theme will play very well. Since the month of February to May, on actually even till now, the MNC manufacturing sector has actually given returns which are positive. I don't know a single stock in that category. Some of them I own, some of them I don't own. But I don't know a single stock in that category that gave negative returns vis-a-vis the market that actually fell on the small caps and mid caps by about 20%, and on the Nifty by about 10 or 12%. So that was the strategy, and the strategy now remains. And I put it up on Twitter also that I'm selling my large caps to buy small cap and mid caps, and that has really worked well. So that was how I positioned myself on the market.
Right. So, all throughout this, did your risk management strategy also change somewhat?
So this is risk management. No, so what you basically saying that there is a global turbulence. What happens in a global turbulence is that a company that has to export orders, or a company that has to cater to orders in India but requires raw materials, could get impacted. So the shift, rather than saying that I will move out of the market, because that's a very difficult decision to sort of say that I will, you can say 5% of your portfolio you've reduced, 10% you've reduced, but rather than doing that, and to sort of look at your portfolio, which already includes stocks that you like, one strategy of defensive for me was to buy MNC Pharma, because MNCs cater to the world. Sorry, not pharma, MNC manufacturing, because MNC caters to the world, and they have technology. So I felt that if the world is in a doldrum, they will move to a low cost producing nation, and India's labor is relatively cheaper still, and in some cases even the effects of the gas, things like gas and others are relatively cheaper, not petroleum. So I felt that some of those companies, guys, will take a cost arbitrage and move towards India, and also because they're so deep rooted in terms of time. If they find that the facilities in India are not being used, and of course they are already trying to move away from China, and now there are problems in Europe of manufacturing, and other than these companies will benefit because the orders are given today but executed over a long period. Like a company gets 1,000 crore order, it takes a time to execute, but the 1,000 crore order changes its fortunes for the next quarter and the next quarter and so on. And also because what happens is that since now there are issues of transfer pricing and related party transaction, etc., these are done at arm's length, so they cannot squeeze out the ability of the Indian company to sort of earn the kind of profit that it would have done had it been an independent. So therefore, that was a risk mitigation strategy. Banking was also a risk mitigation strategy, because in it's like this: if there is, if there is a deterioration, in the deterioration, the leader will take the opportunity. And the leaders in this particular case are guys who have capital, and the capital doesn't have an NPA effect, or it has a reduced NPA effect, so it becomes good capital. Now the only point is that where does the capital go? Does it go to industrial purpose? Does it go to consumer purpose? Or does it go into a debt restructuring? Or does it go into an NCLT restructuring, etc.? And I felt that if even if things don't improve, they will not deteriorate for the banking sector. Therefore, the emphasis on the few companies in banking, and also the price point. If you like the banking stock, for example, at 220 rupees, and during the fall it came down to 170, and your horizon had not changed, then why did your act of execution change? So you would have bought whatever money you had at 170 rupees to assume that it would go back, which is exactly how it is played out. So that was a risk mitigation strategy. But I didn't want to be a hero by saying that I'm going to now adventure into unknown names. And that's why I was not buying small and mid caps right from February to this thing, or I was also not buying large cap. I wasn't buying only. But when you had discovered that the problems are likely to tide over, then a whole ocean of opportunities came up, and you had to then latch it on.
Right. Perfect, sir. Thank you so much for sharing that, sir. Sir, on a related note, you just told us a little bit about if valuations, if the same thing that you were bullish on at 220, 170, maybe it should make sense. There is a related, on this related note, there are three investment philosophies kind of. One is valuation based, or maybe buy on dips. Then there is a growth based philosophy, and or maybe you can call it keep the companies that did not fall during the dip. And the third one is just keep doing SIP. Which one do you have a preference amongst any of these, sir?
See, SIP is relatively a no-brainer, because SIP gives you the ability to buy more when the market is down, and it enables you, and when the market is up, you relatively buy less because of the adjustment of amount. So therefore, in that sense, you get the benefit of buying more on dips, and it has always worked, because the mutual fund industry shows that if it is an SIP, there's a difference between an SIP, for example, of index versus an SIP of sectorial funds. So I'm not a believer in SIP of sectorial funds, but basically to buy index related SIP or anything close to that is not it always works. So that's a no brainer. Now, as far as buy on dips is concerned, some buy on dips can also fail, because it may happen that you may be at the start of a very long prolonged problem, and you may ignore that because just because prices have fallen. So price should not be a barometer. The what is the problem in the world, and how the problem is being addressed, and whether it is balanced or imbalanced. What is balance and imbalance means, that you basically like take a scale, and you have 50 on one side and you're 50, which means equal balance, and then you come and say, no, one side of the scale has become 90 or become 95, because Bank of America surveys of fund managers around the world showed that their cash holdings were the highest. The American market giants, which were very large commendable companies, were falling like there's going to be no tomorrow, as if the biggest companies like Apple, Microsoft, Google kind of companies were going to shut down. All of a sudden everybody said that equity market is going to crash. So what happens is that if the scale becomes 90-95% one side and everybody is negative, they would have acted on their negativity, which means that they would have sold, they would have done something to reduce the equity exposure. Otherwise, there's no logic of their being negative. And therefore, what is left is that 5% that is on the other side has already seen the brunt of most of this behavioral science. And in that sense, the opportunity comes. So the FII dumping of the Indian market basically means that some of our great star Nifty 50 companies, the kind of companies they own, had already corrected. But at the same point of, and some of it you may say was lapped up by DIIs. But the question is that what was the reason for the fall? It was high crude, it was high inflation, it was India's relative market being expensive compared to the rest of the world. Now you say the market is corrected, so that is resolved. Oil is correcting, so that is resolved. Inflation is being tackled, so therefore it is a process, transitory process. And then you come and say, the negatives are getting addressed. So that 95% negativity of the bulk of people, and the fact that they were sitting on cash will somewhere get deployed. I mean, nobody sits on cash for very long because then the fund returns are zero. The cost of cash is effectively zero. I mean, they put it in debt funds and they will be compared, they will not be treated as equity funds. So then the opportunity comes, and this is the rule of markets for so many years. That's why you should read books on history and all you need to learn. And this was not a case. I don't call this a case of bubble. I don't understand how even people use the word bubble. How is an equity market that is based upon earnings? And when you talk about price to earnings, and you talk about the fact that the banking cycle in India or the credit cycle in India has not taken off, capex cycle in India has not taken off for years, how do you even call it a bubble? What is the reason that you call it a bubble? So initially, you could say there was a bubble in new age companies, so it corrected. And when you look at some of the other companies, you come and say it's not a bubble, but they have, some of them may have growth problems because of raw material inflation and other reasons, and they were being addressed. And one of the other characteristics that I personally tracked was that during this time when the market corrected, there was very insignificant promoter selling. Neither were promoter selling, or neither there were significant promoter pledges, which basically meant that they were also staying put, which is a healthy sign. And the capital market fell, which is also a very good point. Capital market fell means that the new IPOs fell because the new IPOs were causing a lot of frenzy for money and oversubscription and grey market premiums and whatever. The fact that they also fell basically meant that the excesses of the market were getting controlled. So that appeared to me as an opportunity. It has worked right now, but who knows? From the main point is what lies ahead.
Right. Perfect, sir. Absolutely perfect. Sir, so since a lot of one more thing is a lot of factors are being resolved right now, and over the last week or so, we have also seen FIS selling. Initially, it reduced, and then now FIS have again net buying has also kind of started. But in this scenario, I think although DIS were active and they were picking up whatever IFIs were leaving and they were kind of balancing it out, and yet there was a still there was a huge correction. Of course, Indian market still kind of fared better than the rest of the world, but there still was a good amount of correction. But the moment FIs come back, we again see kind of markets rallying back. So, do you have a thought on that, sir?
See, there is a theory that not a theory or whatever thing that I have started believing in long time back, that the FIIs don't sell. It is not that the market falls when the FIIs sell, or for example, the market rises when the DIs buy. It is that the FIIs sell because the market is falling. So what happens is that it's like you come into the market. Their portfolio sizes are humongous because they run into billions. They are not talking about, even if you look at the selling of the last year, it is a proportion of what they own in India. So what happens is when the market is when the market is falling and they see that the probability of the market deteriorating is more, because for example inflation and particularly oil directly hit our companies, then they realize that this cycle or the spiral is going to continue for some time. So they safeguard, they try and sell because they have to safeguard some part of their portfolio vis-a-vis something else which is anyway going to fall. It's like you also, if you own a stock and you think it is good, but it may fall because something has gone wrong, you'll sell some part of it, and then next day, maybe if you're not convinced, you'll sell some part, but you won't do all or nothing in one day. Now, when the market discovers that the variables that impact that India, for example, oil, or for example, inflation or other things, and also the reaction of the government, for example, do we make silly decisions? Do we make considerate decisions? When they become more balanced, then people will say that okay, the first phase is that I will start reducing my selling. So it was very evident, if you see, that in the last few days, the FI selling first started reducing it from figures like 2,000 crores and 2,500, even 3,000, 4,000 crores they were going. They started reducing it and it became, smaller figures like 200, 300, 400 crores. And then all of a sudden it sort of started plateauing. Now, today somebody may say that today in the cash market they were sellers, but no, you must see that they have done a huge amount of covering up in the F&O segment because they hedge. Actually, F&O is supposed to be an instrument of hedge. It is not a different thing that traders may do whatever with it, but it's really meant to hedge. So today, for example, if you look at the stock futures and you see the index futures, etc., they did a lot of buying there. and to that extent they may have reduced some of their cash position just to sort of balance it, but the net effect is still positive. And now, because the net effect is positive for this week, this is the first week I think in the whole year, if I'm not mistaken, where the FIs have turned buyers. There will be a buoyancy in sentiment. So it's again a spiral. The FIs will buy today, DIs bought. What caused the DIs to buy today and not buy yesterday or day before is something that you can deliberate on. The trader community comes in because now they feel that the top levels, what they call is higher tops, higher this, whatever XYZ, they come in. Then what happens is somebody who's conservative feels that, oh, I missed a rally in the market of so many points because the last 1 week rally was very good. Then somebody reads Safir's tweets and he says, oh, why is he coming and talking about 30% returns for the month of one stock or 15 or per days, 30% returns? I'm missing out. Let me quickly pick up a list and buy what I missed out because I don't want the feeling of FOMO. So there are so many spiral effects. Then somebody will come and say that, it's very strange that now Standard and Poor says that the banking sector will do well. It's very strange. Today, I put up a statement of a very large US fund that says that no, they're going to increase their allocation in India. After next week, you will discover that all the FIs were written negative of India say that we are removing the coverage. And also, see, that is the psychology. This is what I'm trying to teach people, that when all the negatives go together in one direction, it can be that the direction can prolong with time because, after all, they may have a view. But it is also possible that because there are too many negatives, things will turn around. Like, for example, the everybody said we are negative on the IT sector. Everybody, all the foreign institutions downgraded the sector. And then last week, IT stocks, if you look at some of the IT stocks, they rallied 10% for the week, which is not a small rally. I mean, because you will be buying at those levels. So that I, for example, on my own, I have not been bullish on consumer. The market doesn't care. No? The market took up the consumer stocks because somebody came out and said Unilever came out with great results, so they said, okay, fair enough. Now we will remark the sector, and then it went up for whatever reasons. So you have to take into account that when there is always going to be excesses on any side, whether bullish or bearish, the excesses will always be corrected, and that is why market reverts to mean. And you have to be opportunist to find good scripts. Now, if I, as an example, if I find that I'm just giving a random example, if TCS has fallen to 2,950 and you don't like it, and this happened to me on Twitter. When I was saying that large IT should be bought, the same guys are coming and saying, no, TCS will now go to 2,800. It will go to 2,700. TCS is not a company that's going to ask you where it's going. The day somebody find that there is value in it, don't forget 1 month back they had done a buyback at 4,000 rupees. So that time TCS management said that we are getting such big orders that we cannot handle it. Then when the results come out, they say that only two orders of 400 million, now we're not getting $1 billion order. So why? Because the managements are also humans, and all humans tend to get on extremes. You always believe that it's either going to be one side of the pendulum or one or the other side, but in reality you have to be more rational and say it doesn't work like this. So you have to balance yourself. Now, whether you bought IT or whether you bought consumer or you bought small caps or you bought, like, for example, infrastructure sector. Now everybody knows that infrastructure sector in India has destroyed a lot of value, but you are not being right, because what is happening is this government is hell bent on infrastructure. They have demonstrated it with the road projects. They demonstrated it with the airport project. The infrastructure companies are not coming and saying they've not paid us, because now they have such a buoyant GST collection that they are themselves saying that we are collecting more. Even the tax that they imposed on Reliance and others, they said is meant for infrastructure. Then all of a sudden you'll come and say, but infrastructure company, and they're getting orders. The infrastructure order books are booked. So then you'll come and say, but now after 2 quarters we missed it and they all doubled. So we have to understand, no, where should we be positioned? It's like I'm not a golfer, but the way the golf guy balances his body before he strikes, it's the balancing of the body that causes the ball to reach the ultimate hole.
Right. Perfect, sir. Absolutely great. Thank you so much for sharing that, sir. Sir, I have a lot of questions from audience, and one of the very question that keeps on repeating for you, especially, is so like in the beginning of the space as well. I said you are a man of many talents, and you do so many things. So one question that keeps repeating, Suresh Chaudhary sir has asked, how do you read so much, and what exactly do you read in your with your morning chai biscuits? Ravi sir had asked, how do you find your gems? And another tight question, which is which newspaper do you read? And then another question was Shrikant by Shrikant sir. He asked, how do you read so many things? How you remember so many things? So I think there is a connection between all of this, which we all want to learn from you, sir.
Yeah, surely I'll answer that, but one feedback that I wanted to give to you was that, for example, the last one or two sessions that you did of with other speakers I had joined in, and I felt, and your sessions are very centric around the speaker. So sometimes what happens is that you overlook the importance of some of the other people who have joined. Like, for example, while I'm talking to you, I find that Deepak has joined. He's very, very good with stocks. Devina has joined. Devina has a very good knack of the global market. After all, she runs first global. So sometimes, while I will talk and give an answer, sometimes we should encourage these people because it's not easy to grab, the best of brains, and you must give due credit to them because they can bring a perspective which will add to the perspective, or maybe actually even better the perspective of your speaker, and therefore make it more holistic. And it's a great opportunity, and that's the advantage of having forums. Now, as far as reading is concerned, see, every single person, it's like this. Let me turn a disbeliever into reading, and then I interact with anybody, whether it is a successful entrepreneur, or it is a successful investor, or an economist, or anybody else. Reading is something that will open many dimensions to you. What will happen is that you will find, you pick up a good book and you finish the book, and by the time you are going through the book and finishing it, ideas are already coming in your mind, and ideas that you believed in, some of the things that may be wrong in your mind are getting sort of washed away, because sometimes you just get carried away, and it's like a balancing act. So it is a great opportunity for people to read. Now, the reason why I read newspapers was a long time back in the legal profession itself. One of the most accomplished lawyers of India, Mr. Kapil Sibal, said that he does not read so much of case law as opposed to newspapers, because he says the newspapers contain all the legal developments, because case law you can research, it's already there, it's out. But the newspapers are telling you the future of where the case has not been written. And why is it there? Because their policy is there. The policies have plus and minuses. Somebody will have a dissent on a policy, which is also good, because the dissent is also important, and it will have an important role to play in where disagreements will come in. You will read about international news, you will read about trends, you will read about business collapses. So many things are in the newspaper. It's Newspapers are not just about reading the sports page and about what the film stars are doing and the XYZ. It's all about the fun of reading, some of these important things. Sometimes there'll be statements, the numbers of, for example, the economy will come, and somebody will say, but these are actually good. And you'll say, why are they good but they look very bad? Or in results, I mean, it happens so frequently. A result comes, they'll say company's profit is down 60%. Like yesterday, Sears profit was down 60%, and they said the stock will tank. The stock closed at days high. So you will find opportunities, because somebody will now start analyzing and saying, is the worst in the raw material, or is it going to deteriorate? Many such examples of things. So that's why reading is something that you do. And then, I always say this, that anybody who shares his list of books with you, or shares his articles with you, is one of your best advisors, because what he's trying to do is to make you a better thinker. And a better thinker will make mistakes. We will all make mistakes. We are all humans. But we will learn from some of these mistakes. And when we learn from some of these mistakes, we'll refine processes. And that is what is the art of mental modeling. And then you will become disciplined. Like, suppose I don't know of a stock, and say Deepak or Devina or somebody are very bullish about it, very bullish. So what will I do? I'll say I'll take a 1% exposure rather than taking more. I'm just giving you a random example. And then over a period of time, you will understand why they were right. And if they're right, and you'll understand what was it that I thought that was wrong. And that itself is the biggest learning, because market will give you too many opportunities, but to capture those opportunities, you need to have your basic learning right. Otherwise, you will, if you just keep standing and saying that this is doing well and that is doing well and let me latch on. Or similarly, if you emulate people's portfolios and you keep buying so many people, I was just had a meeting with the top editor of a newspaper, and I was telling him that if you look at it, see, Mr. Junjanwala got three or four very things really right. For example, a Titan or a Crystal or something, but he got so many things wrong. Yet what happened is that the three that were right or four that were right, he kept building upon conviction. So sometimes you're buying on the tops, or sometimes, and what went wrong, if was 1% portfolio, in a particular company went wrong and it even went to zero, then how did it matter? Which is also what the book one to 100 or whatever the name was telling you, that if you get one stock that becomes a 100 bagger, and you have 99 stocks that don't perform, still your portfolio is not going to be negative, because then one guy is already given you 100% returns. But the probability of 99 failures is your problem, and you have to ensure that you don't have 99 failures. And if you bring that 99 failure number down, then your portfolio would have done relatively better to the market, which is where your attention span should be.
Right, right. Absolutely, sir. Thank you so much for that. Sir, as you said, I already requested some of the names you took. I sent a speaker request, and you're absolutely right in that. I mean, they are really great people and really difficult to get a hold of. Uh, uh, I have sent them a request, and we have a lot of. Meanwhile, we have a lot more questions for you as well. So I'm hoping they'll join in. And I've also invited, and you have graciously accepted to be a co-host. So you also have a few full view. You can invite anybody, and we can have a broader discussion as well. Sir, I have a lot of questions. I pinned a tweet in this, and we are getting a lot of questions. I'll try to avoid stock specific questions and try to keep it more focused on a broader learning perspective. Yeah. So one of the question is by Bhavya sir, and he has asked favorite books on investing from you.
No, see, there is a difference between books also. See, because times change. So, for example, if I did not know Thaler some years back, then today I may think that, he's a good thinker. For example, I may like Fooled by Randomness by Nassim Taleb, but I may today find that, some of the newer books that came were not so pertinent. People's ideology change. I could be a good thinker at some point of time, then I may have made a judgment error, or maybe I live in a country where some turmoil happens, and therefore the situation around me changes. So what happens is you have to be, and then and there may be new authors that you come across who use books you don't know, but then after some time they become bestsellers. So you have to read on a variety of subjects. For example, if Professor Jeremy Siegel talks about the fact that stocks are for the long run, then somebody else may also talk about the fact that the returns from a stock cannot be, in many cases, cannot be infinite, and good companies self-destruct. Somebody may talk about the fact that there has to be a difference between value versus growth. So the books on value versus books on growth are very different. That is why you saw that the IT companies and other places, while they were growth companies, they corrected, and again a lot of value emerged. At some point of time, you may not like metals because you may call them a commodity, and this is immediately after a metal bull run, or metal prices fall too much, then you'll come and say, you know what, now I like them, because now with that price there's not only value, but there'll also be growth, because inevitably at some point of time there will be consumption. So you have to keep reading different kind of books. Now, as far as my favorite books are concerned, I like books on behavioral science, simply because the books on behavioral science pick up a lot of anecdotes and examples to help you think better. And I find that if I'm able to think in a better way, then it enables me to hopefully take better decisions. Whereas, for example, I like to pick up a book, like if I find a book in the market that says, and this happens more in America and less in India, they say 100 best ideas to buy for 2025, then what are you talking about? I mean, that doesn't happen like this, no, if it was so easy. And then you also have to read a lot on, for example, what the competitors say. It's not about just the company and its annual report, it's what the competitors say. Now, if a competitor is talking about the same set of problems that are temporary in nature, for example, raw material or something, then you have to see who's going to be the leader to emerge in order to tackle. Because if you say that the company is not a leader, then you cannot say the management is so differentiated. But you can't at the same time look at an award that is given by a business magazine and says that these are the best companies for the year, because if you see, a lot of these companies that make it to best companies of the year are not necessarily wealth creators. So reading is not something which is limited. In fact, somebody once gave me a very good advice. They asked me what kind of books, and or in that particular case, what kind of magazine do you read? So I said, I, for example, read sports magazines, I read business magazines. So they said, why don't you read magazines on interiors? So I said, it's not my subject. Okay, why don't you read magazines on health? I said, it's not my subject. So they said, do you understand that if you pick up these magazines and start reading it, you will become a better thinker? And I've at the end of the day said it's so logical. If I read about health, and I'm able to improve my body and my mind and my sleep skills and many other things, and I start understanding the human body. Some of the Professor Bakshi and others have shared, and some very good books that are to do with health also, and other people also. Then you start thinking, yeah, I'm becoming a more holistic person, because then I'm going to be able to control. I remember that once, I today wrote a letter or whatever, a tweet for Prashant Jain. I think the first thing that impressed me about Prashant Jain was that whatever happened, he brought meditation into it. And I used to think, yeah, this is very cool. I can't do it, so let me learn from him in that sense. So you should read on a variety of subjects, and that 100 and 200 and 300 rupees that you send on a book, which is not even the cost of one meal that you order from outside, that learning remains with you in perpetuity. So, or for a long period of time, if not in perpetuity. So pay a lot of importance to books.
Right. Absolutely. That's brilliantly put, sir. Thank you so much for sharing those insights with us. And I couldn't agree more. Like, you have to have a holistic view in life and in general to be able to cope up with it. Just one focus would just not lead to it. Absolutely brilliant,
See,
sir.
the other thing also that happens is that when you read over a period of time, then you understand that this has happened before and this is how it came out. Because, for example, there are economic depressions in the world. There are peculiar problems that happen in companies. There are peculiar problems that happen on legal compliance. There are peculiar problems that happen. For example, suppose there is a headline news, and this has actually happened a few years back, that Hindustan Lever settles a case because they forgot to report something to the exchange. Then you're able to differentiate between the liability of Hindustan Lever's directors in not disclosing some, buying and selling of 800 shares that was overlooked by some mistake, vis-a-vis an issue that where they have done some illegal activity and profited. So you realize that there is a dividing line. Now, suppose the headline comes that Hindustan Lever has settled a dispute because the director, because suppose they say you settled a dispute with SEBI, and that day the market takes the stock down 5%, and you look at the market cap of Hindustan Lever and say, do you think this is something that was so atrocious in nature for the market to behave in this way, or is it genuinely a human error? You can do a lot of dividing lines like this, and over a period of time your mind, when it reads, it gets into a compartment of at least trying to understand what is the difference between a gross problem, and, for example, a temporary problem. Also, managements, like, for example, if TCS management told you that we are getting too many orders, which happened when they were doing buyback, and then all of a sudden now they've come and said that we only got two orders worth 400 million, and the large ticket orders are not coming, do you actually feel that the management is deteriorated? No, it's just an environment. So therefore you're able to differentiate that. Another guy who doesn't read and only reads the headline, and that day sees that TCS says no big orders and only two orders of 400 million, will write off the company.
Right. Perfect. Basically, you're able to read between the lines when you read
It's like
increase
a
the breadth
habit,
of
na?
it. Yeah.
The biggest example of this happens to be on the television serials front. If you are watching a serial and you miss a few minutes because you got up to take a call or you went out to the kitchen to make something, you don't really miss much. But if the movie is only 2 hours, and then you've left between something in between, then it's got very little your attention. That's why, Hindi movie में आप कभी भी आ जाओ, आपको कहानी समझ में आ जाती है. But in an English film, which is very engrossing, the 10 minutes of loss, because it's only a 2 hour film, can really become more fatal for you.
Absolutely brilliantly put, sir. Okay. So, all right. So, I've got a lot more questions. Okay, this is an interesting question, sir. Charanjeev sir has asked, which sectors do you find undervalued currently in addition to banking?
No, but why the question on sector? See, why not the question on companies? Because
Yeah.
how do you ascribe a sector to be undervalued? At least, see, there are certain people who are masters at data crunching.
Hmm.
They will be able to put forward a lot of data. For example, sometimes even I go on Twitter and ask some of these people to share data, because they will pull out the data, matter of few minutes, and they've got all these databases. They are tracking data not only for India but also compared to the rest of the world, etc. And they will be far more competent than me to answer this question. So when I don't have the competence to get into certain things because of, say, skill sets, I ask myself, what do I skill set do I have? So you take a sector, you can take the most plague sector, which basically means a sector which is not doing too well. Now the leader in that sector may still do very well. Now, I just gave an example that, the last few days there were so many negative articles to do with the ceramic industry and how it is into a completely glut situation, this and that, and Kajaria was being downgraded left, right, and center. The downgrades were happening at a price of 900. In 1 month's time the stock price is 1135. So for you the question was that is Kajaria a good company? Just keep your question simple. Is Kajaria a good company? Does it still make good products? Is the management changing? Is the deterioration of the decision making powers? Is the market getting is it getting too fixated by a problem which may be temporary, or is it a long term deterioration? For example, is it obsolescence? What is Sarah saying about this? And then you actually track it and you come and say, this has become an easier way, because it's like I'm only talking to my own soul to get the answers. And then you come and say, okay, at the end of it, either I've got a certain answer, which means it is a great company at a great price, or I've got an answer that it is a great company, but I'm not sure about the price because I don't know the behavior of the market and I still don't know the behavior of the large players who may be holding it and selling it. If you don't know, if you know for certain, it's like known knowns, known unknowns. If you know for certain, then you buy it. If you don't know for certain, then you buy a little bit, and then you put your thesis on in your own diary and say, I will look at these theses to see. So I don't find that there is reason, even if you've taken a 1% exposure in the company, that 1% exposure in the company can turn out to create a lot of wealth, because it will give you the opportunity to keep increasing when your conviction keeps going up. But if you don't enter it, you remove it from your mind. Now you've removed it from your mind means you're not tracking it. So if it was a great opportunity and you removed it in your mind because you had too much of negativity around yourself for whatever reason, sector reason, company reason, or whatever reason, or result reason, then it becomes even more difficult to convince a mind which is already decided. You're like, why are you're going to fight in your own brain with your own self?
Right. Absolutely, sir. Thank you so much for that, sir. Okay. Next question, sir. Eklavya sir ka hai, and he has asked, do you categorize your stocks in your the stocks in your portfolio as long-term and short-term investments? And second, in the last decade, how has your evolution been as an investor?
So see, I obviously when you buy a stock, you will buy a stock with the assumption that it will do very well. And if the assumption, and very well is very relative, very well is very relative compared to the market. For example, if the market goes up 10% and your stock is doing say 12%, then it is doing well. If your result expectation of the sector is X and your company is delivering better than that, it is well. If your result expectation, or if your expectation from a company is A, but the company is diversifying to do some bigger things because they are trying to evolve for the next level, and therefore they are redoing their entire company like an IBM did when it moved away from hardware into other things. Then it is, or an Apple did when initially Apple's founder was not interested in launching the iPhone, but they decided everything would have been Mac for them. But then today, a substantial part of the revenue is only iPhone. Or for example, so you have to take a call based upon that and have to look at it. And then if the company is doing well, then there is no reason that you will not be a long term investor. But just because you bought a stock that had done well historically and all of a sudden, as for example, it is falling, and you want to overlook that fall without trying to see that is there a change. For example, say for example, a company that is in cars and it is faces a threat of EV for some reasons, and you don't know that which company in EV is going to emerge. Is it going to be an existing company, or it is going to be new players, or it is going to be players from the unlisted segment? For example, like suppose a Toyota or a Hyundai in India, they may be listed outside, but I'm giving an example from India. Then just because it has historical returns and you want to own it, and you just look at some 52-week high number and you say that because it was 7,000 rupees and now it is 6,000 or 5,000 and therefore it will go to 7,000, that is called a blind spot. You're basically ignoring a change, and that doesn't work. So you have to analyze it from that. Like, that's what I say about consumer companies. See, consumer companies have already squeezed out efficiencies to the maximum extent, so they are only going to be able to play a limited game of they may be temporarily mismatched. Like for example, as you saw in ITC's case, and why it was re-rated, because there were allocation issues and between the tobacco and the non-tobacco business. But in some of the other places, the efficiency matrix is played out so well that you will only be betting upon the fact that if all of a sudden, it can't be that I'll eat 10 packets of biscuit if I was eating one. No, You'll The fact that I will move from a level 1 biscuit to a level 2 biscuit to level 3 biscuit is not something that is so rocket science to basically think that you're going to make spectacular returns. So you have to look at what is the trigger. And that is why I like companies that say we are reinventing ourselves. When they reinvent themselves, they basically are trying to develop new models. Some of them are transiting very well. Some of them have changed. Some of them give up good businesses also to go into the next level. Some new businesses keep emerging. You also have to track a lot of new businesses. There are a lot of stars that emerge that we don't look at just because we're so enamored by the existing stars.
Right, absolutely, sir. Thank you so much for that, sir. It's a related question, and partially I think I can kind of understand the answer already, but I would love to have a more clarity on it. The question is, how to decide when to sell, like at, so for instance, if you've invested, like you said, key to, because you believe that a company is going to do well, but then it falls 25 to 30, maybe it falls 25 to 30%, and uh, then do you, maybe looking at that loss, do you maybe re-strategize? And second is, so one is exiting when company is making a loss, so maybe looking at its factors, and second is exiting at once you've got 25 to 30% profit. So do you book what you've got, or do you still keep looking, is there more potential to grow? How do you decide on that, sir?
No, first of all, the decision to buy and sell should not be fixated only on single price movement, because don't forget you're talking about 20-25%, but with the sort of rules that we have in the exchange of 20% circuits, there may be a situation where, and this happens so frequently also, you may find that one particular day, let's assume that somebody basically has a redemption and he owns a substantial part of a particular company, and he finds that that particular day is going to dump that particular company because he has redemption, not that he wants to redeem, but somebody has put pressure on him. I'm just giving you one example. So he decides to sell, and that day there is no buyer in that counter and the stock is down 20%. So the question you should not ask is that the 20% going to is it really causing me to get a sleepless night? The question you should ask is the value getting more attractive? Because that is what you're chasing in a stock. Now, when a stock goes up 25%, I'm actually encouraged to think that is my thesis on the stock working? And if my thesis on the stock is working, and the margin for of safety for that company is going up because of either the quality of earnings or because of the success of a product that was about to launch, or the management has recast capital in a way to make the allocation better, or for example there was a risk of going into an international jurisdiction where you felt that they will take on too much of debt which they have not taken on, and therefore they have not sort of risked the balance sheet. Then you will have two decisions. Either you will say stay put, which is a very smart decision. If it's working, it should work longer. Or if you are convinced that no, it is actually working out to be better and the risks are getting eliminated because of the factors, then you will increase your position. Actually, a top up is not a bad idea at all. In fact, it is what I'm telling you. That's why I say that a 1% allocation over a period of time, first it will go up by the stock going up, and second it will go up by the conviction going up. So it's not a bad idea at all. So there is no hard and fast rules that a stock price movement up and down. I mean, sometimes the movements can also be because of irrational behavior. I'll just give an example. Right now, suppose there is a news overnight that there is a problem of Russia and Ukraine has been resolved, and let's assume tomorrow was a working day, and the market opens and your stocks are up 20%. Now, do you think that this is going to last for too long, or that particular day would you like to take some action off? But that day the stocks will be limit up, and then some, and it's not as if limit up selling will not happen. Some people will be selling at limit up because they will know. So they will not wait to think that next, because it is limit up, next day it has to be limit up. They will be smart enough to encash, and they'll say never mind, we will wait, because at some point of time this 20% euphoria will get corrected. And you will see that on days, there are days in our market history when it has fallen very sharply, and there are days also when the market has been frozen. It's not that on that, it's not as if the market doesn't correct. That sense of direction does not correct, it does correct. In fact, there are very interesting days when, in the market, you'll find the script is limit up or limit down with a very large buy or sell order. But the next day it doesn't move. Next day, if the stock was limit down, it opens up. And sometime when it is a limit up, it opens down. But why are you fixated on that day's movement? You should be asking yourself what has changed in the business. And am I getting a adequate amount of, risk coverage and safety for that?
Absolutely, absolutely, sir. Thank you so much for sharing
So
that.
I'll give you another example. Today,
Yep.
suppose a company says I've called a board meeting and I'm announcing a dividend of 200 rupees per share. And the next day the stock price moves up by 100 rupees. Now I'm asking you a basic question. Do you think that you should buy that stock because there's an arbitrage of 100 rupees vis-a-vis the announcement and the stock price move, or should you be selling the stock? So you will ask, you will say that where is the 200 rupee coming from? Are they capitalizing the reserves, or is it that the cash flows have improved, or they have backed a very sizable order and therefore they have confidence? So your rationality of the decision is not going to be based upon a mere number, no.
Right. Right.
That's what I'm trying to tell you. That don't be fixated by the number called price. Be
Yeah.
fixated by the value.
Yeah. Absolutely. Absolutely, sir. Thank you so much for that. Okay. So another question is, this is an interesting question. I kind of want to extend this. The question originally was, are there some companies which can benefit from global warming and heat waves like in Europe? So I kind of want to extend it further. So one, the question was in context of maybe AC companies or something like that. There was a follow up on that, but I also want to extend it to maybe renewable sector and the green companies. Do you see their future in India with the pace they are growing, and if so, at what time horizon?
No, see, there are always sector headwinds that come in. For example, if you say that there's global warming, I'm just giving you one example, and therefore the air conditioning companies should benefit. Let's take a proposition that we say there's global warming, air conditioning companies should benefit. So on the other hand, you will also look at the air conditioning companies and see that the air conditioning companies, do they use gases that are environmental friendly or not? Because if, for example, the gas that goes into an air conditioner, if it is not environmental friendly, then it can neutralize the effect, because then you will look at alternate solutions, and that alternate solution may come in from new inventions and renovations and other things. For example, there were no split air conditioners, and if a company was at one point of time, and if a company at that time was only making window ACs or wall mounted ACs, then it was going to face a threat because aesthetics was a threat there. So like this, you have to evaluate what is going to happen. If, for example, if there's global warming and all the nations get together and they put things on recycling of the environment, and they put things on, the toxic wastage that goes into oceans and others, and by that time are able to resolve some part of the global warming, then all of a sudden you won't say that these companies that I bought and who have now built up these inventories, huge amount of inventories, will sell. By the same logic, you will not say because there's global warming, I will buy a refrigerator company and put my head in front of the refrigerator when I feel warm, because it has even a faster instant relief. Because things will change of that side. So it's not such an easy call to take. What you have to basically take the call, like for example in air conditioners only, if my call is that electricity supply is not is improving, and therefore India is not a deficit country, and there is a likelihood that some of the benefits of this electricity will now percolate to smaller towns and to smaller cities, and then finally to rural India. The real question to ask is that, is it likely that some of these guys will put air conditioners? And if you find that initially you can't take a call, because taking a call means you have become a market survey agency, but you go to some of these places and say yes, they're putting air conditioners. Why they're putting it? So the answer could be prestige, the answer could be differentiating themselves vis-a-vis their neighbors. The answer could be because in the house somebody got married who was exposed to urban India, and he now feels the need to do that. Which is what I wrote when I wrote about the sanitation, and I wrote why, for example, bathrooms have to come up. I mean, it is a human requirement, and how you're not going to make bathrooms everywhere. So then you start analyzing this, and then somebody will come and tell you that, while you are thinking of all this, there's actually innovation happening. If you see, the price of air conditioners are not going up. It is not as if the price of air conditioners has gone up commensurate to what has happened all around the world. Even look at your cinema tickets or anything else has gone up. So the question is going to be, will the margins go up, or will it just be a volume play? So there are a lot of variables that you have to put into your mind, and in order to take a decision. And then you will also find that, as happened with air conditioning companies, particularly it happened in Voltas. Like in Voltas' case, at one point of time, they had a lot of exposure to the Middle East. And that time the petrodollar collapse came. So then they were stranded with project oil. So somebody is dependent on a mall, and all of a sudden the real estate sector collapses, and then they don't give orders. Then what do they do? So it has to be an evaluation. Now, as far as green companies are concerned, it's a good theme because the world is concerned about environment. But the question is that how do you decide which company in the theme is going to do well? Is it going to be wind energy? Is it going to be solar energy? It is going to be hydro energy? It is going to be XYZ? So when you are not very sure, what you do is it's safer to buy a basket, because you don't want a Suzlon kind of situation also in your portfolio.
Right, right. Absolutely, sir. Uh, Brilliant. Thank you so much for sharing your insights on both these aspects, sir. Sir, next question is by Breakout Chat, sir. He's often a guest on our podcast as well. And he has asked how much percent of your capital you can risk in a particular trade or investment.
No, first of all, my question is that why am I calling it a risk? Because the answer to this question depends upon the presumption of where the risk came from. Is the risk of getting no return? Is it a risk of getting sub market return? Is a risk of blow up of capital? They're all different kind of risks. They can be, after all, don't forget that people were making a mockery out of ITC and making memes every single day, and they've gone quite a no when ITC ended up being the big return. So was it a risk of not owning everything? Were you subject to a social risk that you would have come on a social media platform and say I own ITC, and people would have made memes on you? I'm just giving you a side of human psychology. So the risk is relative. Is it a risk of liquidity? Because you may discover that you own a stock where today it is difficult to buy, but it will become even difficult to sell. So if you, when you need money, if it becomes difficult to sell, then what happens? You still need the money. So some, you'll tell your broker, "Niche karke bech do." So, what is the risk that you are analyzing? Once you've analyzed the risk, when you've thought of the risk, then it is to see whether it is a risk or not. Now, for example, I'll give an example. Say your portfolio is worth X, and the market has a drawdown like it had in, say, from actually October of last year or November of last year, it had a drawdown. So your X becomes less by, say, 20%. So it becomes, suppose it was 10 rupees, it becomes 8 rupees. Now, are you going to basically get into the fear of selling all your shares? Or will you ask yourself, no, actually, the problem is genuine today. There's no doubt that there's a problem with Russia, Ukraine, there's a problem with China, there's a problem with in all the fronts of inflation, raw material, logistics. But the problem is not likely to subsist after 2 years. I'm just giving you a random figure. 2 years, I could have said some different months also, but say 2 years. So in 2 years, things will get sorted out. Then these will these be the leading companies then also? The answer, if the answer is yes, will I be able to buy it exactly after 2 years at the same price? The answer is no, because the market is forward thinking. So big money or somebody will come and acquire it before that. So if my, do I need that money today, that in 2 years if it doesn't move, will it impact my standard of living and the things that I have to do, like look after education, other reasons? The answer is no. Then how is it a loss? Then it is only an opportunity. So you have to position risk from the from your perspective, and one man risk is not another man's risk. One man risk is another man's opportunity.
Right. Absolutely, sir. Absolutely. Thank you so much for that. Sir, next I've got like 7, 8 questions, all of them around sectors. So they overlap. And the four sectors that people have generally asked about is energy, oil marketing, specialty chemicals, and battery. So if you have any views on any of these sectors, sir.
Yes, see, so the easiest one is specialty chemicals, because I personally believe, and please underline that I could be wrong, because if I was right, then, if I was always right, then world would be so different. But I feel this, that specialty chemicals is going to enter into another round of a bull market, and I just articulated my reasons for it. I feel that right now you had the benefit of China, you will also have the benefit of Europe. Germany has some very good companies in the chemical space, and this recent requirement to actually reduce their production by 15%, actually the gas production by 15%, could first of all shift some business to India. And also, don't forget that some of the companies in Europe have subsidiaries in India into the same business. So, in that sense, also, it's not necessary that you only benefit in the listed companies, but if the listed company makes something which is very essential, then it will sort of, because see, there are certain parts, like for example, food, chemicals are used in food. Now, you won't say that because there is slowdown in the world, the food consumption will slow down. There'll just be a shift of consumption patterns, and certain businesses will remain inevitable. So I see, and also some of the chemical companies in India are only at the starting point because their innovation is very new. Some of them are still undergoing capex. Some of them are still setting up plants. So they are not catering. They're not talking about the market in 2023. They're talking about a fairly long run. So if you look at it from that perspective, the movement itself from generic to specialty is itself a big re-rating, and some of it has played out, whereas but in, so when it is played out, you have to come and say what is the next trigger that is left for the company. Is it that they are still have innovations in their pipeline, or is it going to be impacted in some way, etc., etc. Where there are monopoly businesses, you have to think, will the monopoly sustain, or is the monopoly being threatened because somebody else is now at an advanced stage of sort of development of something. Where it comes to products like batteries, I would not even touch it because it is beyond my assumption to think that just because there were two companies in India that were listed, those two companies are going to crack batteries. No, actually, the battery cracking may happen from a third and fourth and fifth and seventh player that you haven't even heard of. Because newer companies, some startup may be doing something on the battery front and will capture the market. When it gets listed, you can evaluate it. But today, it is very difficult to take that. So that is on the battery. And what was the third and fourth sector?
So there was,
Energy.
yes,
Now,
energy.
what do you call as energy? That is also very relative because energy itself is of various form. Are you calling it power? Are you calling it what is are you calling as energy?
Right. So I think energy is power stocks would mostly qualify as energy in this case.
So
I
I can
hope.
give you two sides. See, power stocks historically have had misuse. They've had a lot of leakages. They have had issues relating to states not paying them dues. There are a lot of dues. Discoms have the power coms have a lot of dues from the state. So some of on the positive side, you can say some of these will get resolved. On the negative side, they are very bad allocators of capital, and the history of the power companies in the international markets, General Electric was the biggest example of a power company. Though the history of the power companies in the international market is not so conducive for you to believe that they will be consistent wealth creators. At least I don't believe that. Now, as far as OMCs, the last is OMCs.
Yes, sir.
I will never touch it because it is in the very nature that when they make profits, you tax them, and then you impose upon them the burden of other things because you have to, at a collective level, at a nation level, you say that now you're making too much of profit, so I will tax you and take it away in some form of the other. So if they're doing well, you squeeze out the dividend, so you don't leave capital with them to grow. And if they are in a problem, then you let them be in the problem. And if the nation gets into some slowdown, suppose there is a deficit tax collection, then what will happen is you immediately say that no, I'm going to squeeze it out of you. If the market goes up, then you immediately announce the divestment, and in that process you offer a discount to the public and you make it cheaper for the public. So on the announcement itself, the stock corrects. So why would you like to and then you have a risk of what will happen to oil. Of course, it is not an immediate risk, but what will happen to oil in general. No, so I won't touch them.
Right. Absolutely, sir. So next question, there's one more question on one more sector which is quite interesting is IT, because they had a huge rally, huge run for quite a long time, and now they're kind of taking a breather. But then with rupee falling and the same time US is increasing, so that is still its Fed rates are still being increased. That is still a concern. But in general, what is your view on IT sector?
It's very simple. Let's forget about whether I have a view, right, wrong, anything. It's a very simple trend. You have seen 10 years, 15 years of growth of the IT sector. Why are you even asking this question? It is not possible. The IT, by its nature, is a beautiful transitory business. It's like a machine that transforms itself. The problem today, you may be addressing digital, you may be addressing cloud, tomorrow you will address this entire web 3.0. Then you will say that now we are getting into a meta world and we will create meta requirements, and therefore there will be a lot of creation of IT related to that. Then somebody will come and say it is a measurement of efficiency, and whether it is in the form of an ERP or a SAP or something of the other. So the beauty of the thing is that these companies are able to regulate and move from one thing to the other. Don't forget that the players have still been the same. Which there are new players that keep emerging, but the players have just been the same substantially. So the very fact that the sector has grown, one, the very fact that the sector has been able to accommodate new companies and yet grown, two, the fact that the operating profit margins of many of these players continue to be very high, three, The fact that they have been able to modify the business models from time to time and therefore been more versatile or sustainable or whatever you call it for itself is an answer to you. I don't see any possibility tomorrow when you talk about, say, at some point of time, you'll say blockchains have set in. At some point of time, you will bring in artificial intelligence in a much more meaningful way. In some point of time today, you may be saying that, if you look at the entire technology on this detection, what's it called, the QR codes. Today, what is the level of acceptance of QR codes versus where it will be? I mean, you cannot have a system where you've started tapping your credit card, but you will not take it to a level which level. You will not bring it to a level when it comes to so many forms of utilization of QR. So technology is inbuilt. There cannot be any other progression except for technology. So I'm least worried about the fact. See, when the price is also correct, who are these people who tell you that IT has become overvalued? Who are these people who come and tell you? The same people who told you to buy it at higher valuations. And the same people you let the IT stocks go up another 10%, you'll have all the upgrades will come back. So don't get so fixated, because don't
Yeah.
forget they're also moving in a. See, they have to people who write research reports, as an example. I'm talking about. I'm not talking about sustainable people who believe in fund management, like fund managers, because fund managers don't write reports. The others have to keep doing something or the other. No, unka entertainment hai wo.
Bilkul. Absolutely, absolutely, sir. Brilliantly put.
The difficulty is not this. The difficulty is TCS or Infosys or Wipro or HCL or Tech Mahindra or Mindtree or etc. So when there is difficulty, then what happens is that you base, and I don't believe that one company can have only one niche, because
Hmm.
that one niche basically makes it. It's like saying a company has only one client, then it becomes over dependent on that client for thing. So what you do, again, you have to make a basket. Now, if you owned a basket of IT in this particular time, also, if you owned a basket of IT and your stocks corrected, yes, at a portfolio level you saw an erosion. But then what happened? Then all of a sudden, some of them went up 10%.
Yes. Bilkul, sir. Absolutely. Yeah. Sir, I am getting a lot of questions. There are quite a few questions, but of course, you are the batsman batting up kar rahe ho, so and all good things come to an end. We have already taken so much of your time, and I don't want to like chase you away by asking so many questions. So one
Yeah, but
maybe,
I have no problem in answering question, because I also value the time of the people who are
yeah,
participating. If a guy is sitting and waiting for a question at say 10 o'clock at night, it's not about me. It's also about him. So why not give him that time?
absolutely, sir. That's so nice of you, sir. Okay, so I'll keep asking a few more questions. So next is Brijesh Doshi sir ka question. In the next future digitalization index is coming. Please suggest the future of Brightcom Group company is asked. So it's slightly stock
Yeah,
specific,
I,
but
I I will not answer that question, because my views on that stock are very well known, and I do not wish to participate in buying things that have nothing backed in terms of ratios or returns or anything.
right. Oh, sure, sir. Okay. PS sir had asked about risk management and investing that we kind of touched upon in the space already. Uh, Chirag Almani sir has asked about graphite sector.
No, again, such a difficult thing to take. See, you know what it is? It's like asking me, if you tell me what is the chances of IT, I've answered you. Now you tell me
Yeah.
what is the chances of a nut and bolt company. It becomes so difficult to know what is going to happen to a nut and bolt company, because there has to be a certain level of specialization. See, in
Yeah.
some of these companies, it is more like a commodity business.
Hmm.
If you ask me, is the steel sector likely to bounce back? My answer will be yes. Because you'll
Yeah.
ask me why, I'll say at some point of time, what will happen is it is so intrinsic to production,
Yeah.
that somewhere around the world, whether it is infrastructure or it is construction or it is even utensils and other things, it will come back. But
Hmm.
ask me specifically about, say, a company that is only dealing with, and if you say a company is dealing with the process, say to do with metallurgy or something, then I'll say, again, it has a chance,
Yeah.
or a refactory or something. But graphites and electrodes and all are not in my, at least not in my. You'll have to ask a more technical person on that.
Right. Absolutely. Absolutely, sir. Thank you so much. Okay. Uh, Abhishek Rathore sir had asked about how do you manage your time?
Very well.
All right. Next, sir, Bhavya sir ka question is there were two questions. One is buying and risk criteria, which we kind of covered. Second is idea generation process, which I find very interesting. So, how do you generate ideas for investing?
Yeah, just to be fair to the first guy who said about time management, see, I have a rule that whatever I find is useless, I don't waste my time on it. So, like for example, some of you people who have interacted with me on Twitter, sometimes I get so much of love and affection from all of you, but sometimes some of you will also wonder that why have I got nasty with somebody and blocked him? Because I've eliminated my time. I've eliminated the possibility of wasting time on somebody. If, for example, today I put up a news on a fund which has made substantial billions of dollars of investment in India, and they say that we are turning more bullish and we can't understand why the FIs are going away and they'll be back. And one guy has tweeted and said false news. And I had to give him a Google shot to say it is covered in Economic Time, Business Standard, Business Line, this and that. Then don't waste time on such people because he doesn't even himself know why it's false news. He's not even spent 1 minute to Google. He's just come to draw attention of your time and sort of just because somebody has to notice him. Then you remove it means either you block him or you mute him or you just ignore him, and therefore concentrate on what is purposeful. Now, like reading is purposeful. I feel incomplete if I don't read a paper. I enjoy my cup of tea in the mornings and evening. I make sure that I enjoy it, and because it's a part of the life that I must enjoy, although it may be a small sort of a thing to do, but it's really worth my time. Now, if I find something is really wasting, suppose I'm stuck in a traffic jam, I can, if I keep shouting at my driver, what is he going to do? He's not going to ride over the next car. He's not, this is not a Hindi film where he'll take my car all over the cars or he'll jump it over the flyover and make me reach somewhere. So then the question is, what best can I do with the time? If I need to relax, I will relax. If I need to read, I will read. If I need to go on a call, I will go on a call. So I ask myself, what is the most purposeful thing I can do? And that's how I manage my time. And what was the second question?
Yeah. So, second was, sir, idea generation process for investing.
See, idea generation process only requires you to first have an open mind. Because if you have a closed mind and if you are apprehensive about everything and you become doubtful about every single thing, then you will never generate an idea. If you always believe that money is going to be lost because the stock market is nothing but speculation and this and that, you'll never find an idea. You have to find an idea. You have to basically keep your eyes and ears open. You go to a department store. I'll give you a simple idea. Go to a department store. You've taken a cart and you're walking around the alleys, and you, for example, discover that a certain segment of product has come. For example, organic food has come, or the quality of rice that is being sold in the stores is going up. And you just go and ask that guy. You say that, you know what, you've launched these so many varieties of rice. Do people even buy them, or they're just gimmicks, or they're just competing among themselves? So he tells you, no, now people are buying it. Now, similarly, you go to a store and you find that there are dabbas of mithai there. Do you really think that that mithai in a department store that has a very limited shelf life and where you will buy it and it'll expire in 2 days is likely to compete with all the fresh sweet stops that are around you? The answer is no. Why will I buy, for example, a canned rasgulla when I can get a fresh rasgulla from so many options in Delhi? Or if you tomorrow tell me that to buy a samosa packet that is lying in a store, I'll say, are you joking? It may be a good savory, but the same logic works very well when it comes to, for example, your bhujia. Because in the bhujia market, I don't it's it becomes a different thing. The bhujia packaging is good, it is versatile, it can last, it's an anytime snack, etc. So that is called common sense analysis. So one is common sense analysis. Second is that value migration, which where value is migrating from one subset to the other, and it was explained in the book by Andrew Matonsky. But it was also to do with, like, for example, how cycles gave away to motorcycles as a clear example, and therefore all the cycle guys had to abandon the cycles and move to motorcycle, and a huge value was created. It was also created because many people at that point of time found that motorcycles had more power, so they could take two people. It would not have less tiredness. It also became a symbol in certain places of prestige and family relations and all that. So that was an example of value migration. Now, in value migration, for example, I say value will migrate from petrol and diesel cars to EV. The question is, nobody knows which company in EV is going to succeed. It is not for granted that just because you were the leader in petrol and diesel, you will succeed in EV, which is why new companies will continuously come up. then the question is that where the value migration is happening and you are uncertain about who's going to win the war on the automobile front, then you look at the auto ancillary and say, but how does it matter? Whoever wins will buy it from these auto ancillary guys because they have the scalability, they have technology, and that. And you played the auto ancillary, which is what my last talk was. In February, I said, one should buy. I named also two or three companies, but I said auto ancillaries and those stocks, I think, have gone up 50% since then. What is something like that? But anyway, I said auto ancillary should play. Auto ancillary also benefits directly from PLI because and they are meant for export market also, so they're actually export benefit. Now, if you tell me cars in India are going to be sold around the world, I won't believe you even 1%. So you have to play things like this. That's how ideas are come from. Sometimes ideas also come from success stories that you read. You read capital raising stories and you say, you know what, this was a fantastic idea. How come it doesn't exist in India? And then you find a company that is doing it, and you say, yes, I will succeed in. I mean, by sort of buying a similar story, like it happened in telecom when Bharti came for an IPO. The IPO actually got listed below, and the company got listed below the IPO. And then you said, I don't know what is happening in India, but let me look at the telecom market in China and the telecom market in Singapore because they had Singtel as a partner. And you said, Array, it's a very good market, it's done very well in the world. So you bought it. But had you bought Motorola at the same point of time, Motorola, that same example I'm giving of automobiles, Motorola did not do so well after that. Nokia did not. Look what happened to Nokia.
Absolutely, sir. Thank you so much for that. That is brilliantly put, sir. So next question is from Abhiroop, sir. It's a very interesting question. What are the points one should consider when trying to analyze any company result? Also, what are the points one should check in con call transcripts, and how to understand if the management is painting a rosy picture but not performing?
No, but you see, one of the advantage of a con call compared to, say, an annual report is that in the con call you have a group of people who are asking questions on the tough side because either they're invested or they're researching the stock, so they will say, but your margins are getting impacted. You spoke about this capex is not materialized, or you spoke about this client order. So they're putting the other side. The management, of course, can still project rosy, but at least you're understanding one, the extent of the problem or the nature of the problem, and secondly, what is the level of departure. In the annual report, what happens is, and this was learned from Satyam, and this will be learned in repeated times from a lot of companies as in when they blow up. It happened with Unitech, it happened with Syntex, will happen with many times. You will discover sometimes S. Kumar, so many such names. You will find that some of these reports are only glorifying statements. So what you're basically looking at is the cash flows. In Satyam, of course, it was the cash flow was also because of. But see, if today it is very easy to talk about it, that time people, even the most smart people, were not able, because you will wonder why is a software company entering into a relationship with an infrastructure company called Metas, and all of a sudden doing everything on the infrastructure, whereas the what is the correlation of software to infrastructure to begin with? What is the correlation of a software earning where you are basically a service business as opposed to an infrastructure company, which is a very capital intensive business? So when you start, why are these related party transactions happening? So when you start looking at some of these transactions, like in a few cases where people may be very gaga because they have been portrayed something on the Telegram channel and all, you see, but what are you talking about? Your foreign business is not even audited. You don't even in a situation. So then you come and say this itself is a red flag. If you think a company is coming too frequently on television to talk about its stock price, or another company's CEO on Twitter is coming every time now, every second day to tell you that my company is so great, there's something wrong. CEOs don't have the time to come on Twitter to comment upon how great their company is. They're sitting in their offices and working, and they let the market decide. Do you think the management of Bosch, comes even once on Twitter to tell you that look what a fantastic company we are and how cheap our stock price is? So there are a lot of alarm clocks that you have to see. History is full of them, and you have to debt to taking too much of debt, acquiring company after company after company. Any company that acquires company after company after company is only trying to confuse you in the balance sheet. So these are clear examples of trade, and then you have to find the promoter entering into, promoter is telling you this is my best company and he's selling equity. The promoter is telling you that this is a great company and he's floating five other companies to do businesses other than this.
Absolutely. Right, perfect, sir. Sir, another question by Sandesh, sir. This is also pretty interesting. How many quarters performance do you look before exiting any non-performing invested company?
Zero. Because I'm not investing for a quarter. I'm investing for where the company is and where so I'll give you an example. Suppose you buy a stock at 100 rupees and for the whole year it does nothing. But you bought it on the thesis that the company is, and I'll give a real life example. At one point of time, the stock of Suven Pharma was going nowhere. And when it was going nowhere, I used to pick up their annual reports and think, what is wrong with this company? Why is the stock not going anywhere? And I used to find the company earns very well, so the earnings are all good. But the company redeploys that money into R&D, because it wants to move away from generic into proprietary, and it wants to get into specialized compositions. So I, at that point of time, used to send an email, because I never used to talk to the management or something, but I would send an email, I think his name is to Mr. Venkat Jassi, who was the managing director, saying, I compliment you on this very good decision that you're taking to put your money into R&D. And literally used to reply back saying that you're perhaps the only shareholder who says good about me, because the others to complain that the stock price doesn't go on. So I used to say that it's like having a bowl, and in that bowl is getting strengthened more and more, because you're doing everything to ensure that it doesn't break. You're doing the right moves, but no, the market doesn't want to value it. So if it was that stock was stagnant for such a long period of time at 60 rupees, and he used to keep adding it, and at some point of time, I also feel that I doing the wrong. Then I'll read the annual report, then I'll read about how other companies in the pharma sector had developed proprietary and other things. And then all of a sudden, from the stock went up some 60 rupees to Suven even split the company. They in fact gave you free shares of life sciences and this and that, and you discovered the stock went up maybe some 10, 15 times. So the question is that you have to look at it. Then in that case, how is that quarter relevant? Because that quarter was happening again and again. So similarly in Reliance, when Reliance was happening, see, the quarter to quarter, you would be looking at the oil sector margins, and you will say nothing is happening. But at the same point of time, they were using the cash from that business to create Geo. And that point of time, we used to feel Geo will never make profit. A lot of people had said when Geo had come, it will not even succeed, because Anil Ambani had not succeeded before that. So there used to always be articles that time. One brother has taken one technology, one brother has taken another technology. Geo and all will not do well. Why are they going to burn? And then what happened? So how did the quarter matter? Today, Reliance is investing so much into retail that you think that why are they buying all these brands? They're buying every single brand, every single second, third, fourth day, something or the other happens. Now they've even announced that they move into food and other things. But at some point of time, you realize that what is going to happen is they will become the largest owners of the mall without owning the mall, because they're not investing in real estate except their own geo mall, etc. But in all the other malls, where they will be the largest tenants, because they will own food, they will own clothing, right? So what will happen is negotiation power with the mall will change, and if that changes, they will be able to squeeze out more profitability, because they will be, it's like saying if they go, 50 brands have to leave the mall. So you have to you have to say that this is a great mindset. This is like becoming a real estate asset owner without owning, putting the capital in the real estate and getting the entire benefit out of it.
Absolutely, sir. Great, great, brilliantly put, sir. So we've got questions on two more sectors. One is reality sector, and the other is quick service restaurants. If you have any views on that.
No, so quick QSR is a good segment. The question is, what are you looking at? Because see, it's not as though the QSR companies are cheap. They are being given a premium by the market because it's a good segment. What has basically become, like, I'll give an example, that I have sold one of the QSR companies. I will not name, but I've sold one of the QSR companies, because I find that with the onset of Swiggy and Zomato, I have so many more choices. Now, historically, I did not believe those choices were good, because obviously they were not brought to me. I mean, I'd not tasted the food. Secondly, I would have said, Array, but he's so far away. By the time he delivers to my home, it will be 1.5 hours. He will charge me delivery costs. I'll have to send my driver, etc. So I didn't order. But today, all that is eliminated. If everybody gets their food within a certain time and the quality of the food is good, and you have so much of choices, then the level of competition will also go up. No, for the competition level going up at a time when real estate prices are up, fuel prices are up, manpower cost of delivery is going up, etc. Tomorrow there will be entire fleet change of vehicles towards e-vehicles already started happening. You started because of some labor reasons you will start giving more. I mean, look at this court order yesterday. The courts have yesterday said that restaurants that serve food can charge service charge because it's discretionary, you go to the restaurant, but if they deliver the food to you they cannot. So what will happen is that money, delivery money that is gone, which was the service charge that they were putting, essentially is how they were trying to tackle salaries. So now how will they pay the salary? They'll have to pay it from their pockets or incentives to the staff. So it has to be a call that you have to take according to a sector. If you believe that the QSR segment of that particular product has got great opportunity because it's rave, everybody loves something or the other about that, then it will do well. Again, my logic is that rather than playing directly QSR, why don't you play the themes that cater to QSR? Because then it will not matter whether it is a McDonald's or a Pizza Hut or Domino's or XY, that if the guy who's providing, suppose you find the guy who provides you to all the three, then
Right, right, sir. Absolutely. So we are still getting a lot of questions on how do you manage so many fields so well, from stocks to legal to art to books so well, and how do you focus on so many things at once?
no. So I've answered that. See, first of
Yes.
all, you should only do things that you're passionate about. If you start doing things, there are a lot of things in life that I may not be good at, and certain things in life it may bore me. Now, if you make me sit in a meeting that bores me or things that I do not do in life, what will happen is there'll be a tiredness and you will not be able to last the entire day. On the other hand, if you do things that fascinate you or will pull you, then you will be able to do, not only will you do them, but you'll find an extra energy in you to do them. It's just like the ability of a cricketer to hit a six, and you will find that all of a sudden he had extraordinary, strength to hit that six or to even come out with an unorthodox shot. So many cricketers are able. You At one point of time, there used to be debates that the time that from the time that a bowler leaves the ball to the time it comes to the batsman is such a fraction of time that how do they even plan their moves. But today it is all changing because they're getting trained to do things and they're excited about it. They become heroes when they discover, like Dhoni, when he created a helicopter shot, became a hero, and it was a highly successful shot for him. So the thing is, you have to first find what is it that fascinates you. Now, within what it fascinates you, you have to maximize it, because it's like saying, I found good, now I must do more good. But if what does not fascinate you, like for example, if I'm not good at certain things or certain subjects, or if I find that on Twitter certain people have nothing but only a negative mindset. I mean, there are times when I put up the other day I put up the stock and I wrote that I'm sorry I did not share with you. It's a small cap stock, but I bought it, and the reason I didn't share because in February, etc., the market was doing bad. But to my shock, the stock has done well, and name the stock. There were at least 10 or 12 people who, that one tweet of 4 lines after naming the stock, was saying stock ka naam batao. So you can't waste time. You can't keep replying the whole day as if you were a concierge desk of a hotel. Some things you'll have to leave to people. There are sometimes they put an article in the newspaper and they say source. What am I supposed to do? So you have to, if somebody asks you an important question, like this is a good question, how do you manage time? It will benefit a lot of people. You ask me, even if you ask me what food do you eat for lunch, it's a good question because you may have a health perspective. You may want to understand, are there more energetic food or something. But if you keep asking me useless things, or I meet people, like if I'm driving in my car and I find that there's a quarrel happening on the side of the road, should I stop my car just to see that quarrel? Like many people stop. What am I going to do? I don't have that time. I'd rather use that time more productively. So you have to find zones of productivity and maximize them. And you have to find what drags your energy. And what drags your energy, you have to minimize.
Absolutely. So I think that is that in itself is a skill that one really needs to practice and develop, because it's very easy to get distracted and get involved in such useless, roundabouts. But yeah, that's brilliant, sir. Uh, so another question is, do you use any technical analysis whatsoever in your stock picking?
Never, and have no intention to. And most of the top fund managers that I have met or have interacted with have never in their life seen technicals.
All right.
Because
Okay.
tell me something.
Hmm.
If a stock is suppose today, and I, I'm everybody's got a different competence. It works for certain people. But I look at a stock, and tomorrow it is the stock is down 20%. Like right now, in the market corrected, a lot of stocks. If just do this exercise, all of you do this exercise, you will see that in the last few months, there were headlines in the newspapers were that so many stocks are hitting 52-week lows. Then some people commented to me, why are you even commenting upon this? Nifty's also hit a 52-week low. Then that Nifty, that 52-week lows has gone up. Certain stocks have gone up 25 to 30% from there. So what will that chart do? Whereas, and on the other side, what will happen is, if the stock has fallen, and whatever it has fallen, and your chart says it is at a low, and now it's going to kill support level one, support level two. That day, some Mr. Ashish Kacholia comes into the market and he buys 5 lakh shares of that company. What will your chart do? Next date will come in the block deals. 10 circuits or 5 circuits, whatever number of circuits the stocks will go up. Then blogs will write, Dolly Khanna is buying this, so and so is buying this, etc., etc., etc. See, so many variables decide a stock. Then how does it matter? Then management will come in and say that we have also bought. Then some people will say, "Arey, that's a very good sign. The management is also buying." Because the management is not looking at a chart, they're looking at the worth of the stock. So I'm not a believer in this, and it does not matter to me if stock is at 52-week low on charts or it's 52-week high. I mean, stocks at 52-week highs fall, na. You saw the correction in IT. All the charts were supportive of the fact that it will not fall. You saw the correction in some of the chemical names when it fell. So these things will happen. By the way, just for information, the other day I put it up on Twitter that, amongst other things, I said, I like Ultratech cement. So people were saying, "Arey cement, abhi cement sector mein downgrades ho rahe the in the last few months." Ultratech, just for information, Ultratech cement is up 30% for the month. It's not a baby. Ultratech Cement is the largest cement company when you look at the market capitalization. So, and now if you tell me, look at Nifty 50 and tell me how many companies hit 30% in Nifty 50. So that's what you have to look at. You have to be the fisherman whose objective is to catch the fish. And if you catch the fish, the purpose for which you are catching it, whether it was to sell it, whether it is to eat it, it should be accomplished. Your objective, if you had the X-ray lights to come and look through the water and to find out the most ideal fish to buy to buy or to sort of catch at the most ideal time when it had just finished eating, and therefore it was in a much more healthy situation, as an example, it's not going to happen. Then you're living in an illusionary world.
Absolutely, sir. That's brilliantly put, sir. Sir, another question is by Finance for You too, and they've asked your view on Adani Group's debt and their fundamentals.
No comments, because I'm visiting Ahmedabad and may I have a client meeting, etc. So no comments.
Okay, okay, sir. Sir, another interesting question since you're in Ahmedabad. In liquor sector, your views on USL and Global Spirits.
No, I will comment on liquor sector. I will not
Okay.
necessarily comment on these two companies, because
Yeah.
in liquor sector there are companies that have good governance. In liquor companies there are companies that evade, simply because of cash models that they don't bring to the balance sheet. You find your good company. Your good company will be characterized by good brands. It will be characterized by good governance, etc. So if you find that the company is good, it's a very good sector. It is not. It is not a sector even in It's like, It reminds me of Devdas, the movie, that when there's recession, he will drink. When the girl leaves him, he will drink. When the girl is with him, he will drink, because then he's celebrating, and in case he's getting married, he will drink. S- So the question is, this sector is a very good sector to be invested in. So you have to basically find companies that allocate their resources well, and you remain invested in that. And the
Right.
best part is, if you get tired of whiskey, you go to gin, and you get tired of gin, you go to tequila. And if you put on weight, then you say, now I become very conscious. Now I only drink gin and tequila. And if you sort of lose weight, you say, now I can afford to have in vodka. So it doesn't matter. Everything will work for you.
Right. Evergreen stocks. Okay. So next question is by Lalit G, and he's asked, do you invest in mutual funds or
No,
indexes?
none.
Okay.
Because I'll tell you I'm not discouraging you, and you must do it. Mutual funds are very good. They have done very well over a period of time. You find your winners and put money. Buying exchange traded funds have done very well. In fact, it is very difficult to beat ETFs over a long term period, simply because the composition of the Sensex or Nifty changes, and by that they readjust. But I am a person who likes to read and I like to research. Then what is the point if after all this effort I have to only buy something so predictable? So it's like very personal issue. I like to find my stocks. I like to beat the market. I like the journey. The journey is not just about the benchmarking, it's also about the learning that comes with it. Whereas if I buy ETF, personally, I will have no learning. Although I recommend that people who don't, even Warren Buffett has said to his own fund, he says that after I'm not alive, instead of buying stocks, just keep buying ETFs.
Right. Right. Absolutely, sir. Sir, next is Aditya Soni sir's question. He's asked, "What's your take on aquaculture, shrimp especially, and how to analyze this sector? If you have any views on
Yeah, I
aquaculture."
did speak last whatever spaces etc. I spoke about the sector.
Mhm.
There are three companies predominantly into the sector. Of the three companies, two companies stocks have gone up some 30-40%. So that's become little more embarrassing for me to then talk about those stocks when they've gone up. They can still go up, but you see somebody sitting with a 40% profit is not the same person sitting with no profit now, because he's been able to create buffer just because of the profit. I mean, if tomorrow the stocks fall, if suppose the stock fall, I'll say, even falls 40%, I have not lost money. But you buy it and it falls, you've lost 40%. But the sector, according to me, should have a great time because of the fact that food is globally becoming short. There are restrictions being put on fishing, particularly because of Chinese illegal fishing. There are issues to do with contamination of water and how the oceans have to be preserved, and therefore greater consciousness. They want to put limitations also on fishery, because the count is not being adhered to in some cases. There are standards of fishing that are prescribed that are not being followed. Seafood is considered to be relatively more healthy as opposed to red meats and other things. Therefore, it has a great demand. There are very good logistics and warehousing facilities due to which it can be frozen. So, according to me, it is a good sector that will grow with time. Even people who decide to give up non-veg, even if you see this, many people who give up non-veg, you ask them, though you don't eat fish, no, they say we eat fish. They don't count fish as non-veg in many places around the world. So that basically is a clear indicator. Like some people don't construe egg to be non-veg. I'm just giving you random examples. So these are not likely to suffer. Except eggs is much more commoditized business, whereas fisheries is a much more specialized business. Because if you cultivate it better, the pricing goes up. If you're able to ensure that the variety, which is what Avanti at one point had done when it moved into a different kind of a shrimp feed.
Right. Right. Absolutely, sir. सर इसके बाद मेरे पास काफ़ी सारी स्टॉक स्पेसिफिक कंपनीज हैं so maybe I can run their quickly run out their names, and in case you wanna share your view on any of them, so we can
देखो,
discuss.
before you do that, one
Yeah.
request that I have to use, you should tell people to share feedback on Twitter. I'll tell you why, because that feedback only makes us better as speakers, or makes us, not good as speaker, whatever you want to call it. The
Yeah.
thing is that in stocks की जो recommendations and all हैं, वो तो लोग कोई वैसे भी Twitter में पूछेगा. If you know about the company, only then can you answer. If you don't, if you
Yeah.
ask me about a company that I don't know, obviously I can't answer. I can't just look up a database and answer it.
Yeah.
Secondly, whatever stocks or sectors we like, we
Hmm.
generally talk about them. That is the very purpose of Twitter. I openly talk about the fact that if I like banking, I say I like banking, and
Hmm.
then I support it with articles. Now,
Hmm.
if you start imposing my view on something that I'm not familiar with,
Yeah.
then my answer can be wrong. So why? What is important is the feedback of learning. Are you learning in this session? Are you going
Yeah.
to are you going to sleep as a better investor? Are you going to make lesser mistakes? And have you contributed to the process? Have we told you how to generate ideas or allocate your capital or your time? Some, because you asked on this. Please, that feedback is very very critical. I am noticed right now while we are talking that on Twitter people are only asking, should I buy this? Should I buy that? Should I buy this? Should I buy that? If you
Yeah.
buy it, suppose you buy these stocks and the market falls, then what? Will you
Yeah.
hold it? Will you sell it? Do you have the money? Will you top up? Will you average, or will you just get rid of it? Stock falls 20% and somebody tells you it is broken technical charts. What will you do? I don't know the answers to you. To
Yeah.
answer you, I have to be comprehensive. It's like a doctor. he doesn't see all your reports and he starts giving you prescriptions and the doctor is in trouble. No, he'll never do that, or he shouldn't
Yeah,
be doing that.
yeah, yeah. Absolutely, and that conviction, even if the even if somebody tells you with all the logic and everything, unless you actually absorb it and are have that conviction yourself, you won't be able to hold it. So you need to understand what the view comes from. So absolutely, I completely agree. So that's
And
why
also,
I
the other thing is, you ask me a stock today, I say yes or no.
yeah,
After that 1 week, some development happens.
yeah,
My view changes.
yeah,
I suppose own it and I exit.
yeah,
But I don't have the memory to remember which one of you asked me the question. So are
absolutely,
you expecting me to then put up a bulletin like a notice board and say, now today I've exited this, today I've... The reason why see, some of... So you should ask a question that sometimes you write that you bought some stock
yeah,
and sometimes you write that you sold some stock. Why do you do this? The
yeah,
point is, when I'm buying it, my conviction is there. It may be
yeah,
right or wrong is a different story, but it is there and I articulate my reasons. When
yeah,
I'm selling it, I tell you that I'm selling it because the valuation discomfort is there, or I found a better opportunity, or the percentage of that stock in my portfolio had become disproportionately high and therefore I have to mitigate risks.
yeah,
So the answers, so just because a stock, I'm selling some stock because the percentage in my portfolio became high doesn't mean it's a bad stock. It means I'm only leveling the portfolio allocation.
right, absolutely, absolutely. So uh, this is actually very true. So shall we just for the sake of this, since we have just discussed this, avoid stock specific questions for now, sir, or do you wanna take up a few maybe?
No, if like see, I just answered you on
Yeah,
aquaculture, so it's very difficult for me to. I don't know those stocks and all, but I'm just
yeah,
saying that it's very difficult. If you just ask me as an example, if you tell me XYZ stock लेना है,
yeah.
तो नहीं एक सेकेंड और वो 10% बढ़ जाता है और
Right,
मार्केट 20% बढ़ जाती है.
right,
So first, will you tell me I was right or will you tell me I'm wrong?
absolutely. That becomes very subjective. Yeah,
या एंड वो एक महीना नहीं बढ़ता एंड यू सेल इट एंड उसके नेक्स्ट जैसे ही आप बेचते हो तब बढ़ जाता है फिर.
yeah, yeah, yeah,
So this is what happens. See, when sometime when I write about a stock, people say, even now, I mean, I gave this in my last Twitter talk. Some people who, for example, troll, they said, you got TV18 wrong. So I
hmm.
told them that your question of getting it wrong is very sad. I must tell you that you'll be very disappointed. They said, why? Because I said you forgot that repeatedly I told you to be a diversified investor, which basically meant my risk allocation to the stock was low.
Yeah,
Secondly, you did not read a tweet when I bought at 32 rupees, but you read a tweet when I bought at 65 or 66 rupees.
yeah,
So actually, thirdly, you never asked me whether the quantity I bought at 32 versus the quantity at 68. Obviously, when a stock is cheaper, you buy it more, and when a stock is going up, you don't buy it so much more.
yeah,
Correct? So
yeah,
now you average it and say that my average price on the stock was 45 rupees or 47 rupees and I exited at 44. So
yeah.
I've lost only effectively 47 or 48 in minus 44, it's just 4 rupees or 10%.
Right.
In the same time, the mid cap index and the small cap index has fallen 20%. Now
Yeah.
you calculate that am I happy or am I lost? So they don't know this.
Hmm.
So I say that don't equate it because you only came, you did not buy it at whatever 32 rupees because you looked at the chart and felt the stock is doing nothing. When the chart went from 32 rupees to 80 rupees, you got too carried away. So when you saw 80 correcting to 68 and one Safir Anand coming and writing, you felt, oh, let me buy it now because one, it has gone to 80, so it will touch 80 again, and it is doubled from 30 or go more than doubled, so let me buy it. ऐसे नहीं होती investing.
Absolutely, absolutely, sir. That is FOMO wala thing which unfortunately people have been into, and especially the COVID bull run that came up. Usme anybody and everybody who was investing, and since it was a bull run, everybody fired away, and so people have been used to this kind of investing, which they have a lot of people, including I also belong to that same COVID generation. So these are all new markets where actually people learn the value of fundamental investing, and actually proper investing, I think, can be learned only in such markets.
No, and I'll give you a real example of one of my friends who was a great teacher and he shares a lot about his life and I really respect him,
Hmm.
Mr. Vijay Kedia. Like he gives very authentic interviews. Now, suppose you bought into one of the companies that Mr. Vijay Kedia owns, say called Tejas. You made money. But Mr. Vijay Kedia recently indicated that when he first bought Tejas, it had the stock fell some 50-60%. but he kept buying. You may not have bought, he bought, and therefore he therefore had a lower rate. Now, for example, one of his stocks called Web of Global is corrected from some 800 rupees to 300. You're not going to buy it 300. When that stock goes to 15, I'm just giving example, I don't know where it is going, but suppose tomorrow it becomes 800 and it comes out in the newspaper that Vijay Kedia's portfolio has gone up so much, then you will come and buy. So that is the problem. People don't want to buy stocks when they're correct. When they should be allocating more money, they don't allocate. When they go up and they feel that the story is becoming validated because of stock price, not by value but by price, then they want to pour their money. And therefore, some of the large fund managers in the country face a dilemma. They say when the market is at the highest, they give us we get the highest amount of SIPs. When the market falls, the SIP falls. This is the only time when the retail is working different, because and that is therefore the one of the reasons why the retail investments in mutual funds are doing better.
Right, right, absolutely, sir. So, I've got an interesting question from Dr. Rishabh Kumar. He has asked, we have certain stocks which hit highs and again get corrected and then hit same high. Is it good to swing trade in them? Now, I don't mean to ask the same. So we were actually discussing something similar, where prices, just because it hit a high, there's no guarantee that it'll go there. But is swing trading from a fundamental perspective, maybe in cyclical stocks or something like that, is that something that is possible or even matlab, can be done?
See, first of all, the answer to that depends upon your competence to understand what is it that you are looking at. What is the swing? Is the swing something which is based upon fundamental, or it is based upon chart? Like, I don't do chart. Now, if I as an example bought India Mart at a certain price, the stock price from there went up to 10,000. I sold India Mart not at 10,000 but at 8,000. Now, after that, India Mart stock came down to maybe 3,000 rupees. I bought it. It went back to 4,200. I sold it. The question is, why am I buying and selling? And today I don't own it, as just a standard disclosure. The question is, why did I do this? Because the question is, at 8,000 rupees, it was overvalued. So I sold it. When it fell from 8,000 to 3,000, I felt that, the destruction, the business is not so high. The business was slowing down. Just Dial was also slowing down. B2B was slowing down, but it was not so high that from 8,000 you brought it to 3,000. 5,000 rupee erosion on 8,000 rupees is a very substantial erosion of the business. It's not that something was wrong. And then, of course, in between, the management announced a buyback also. Now, when the buyback was being announced, you look at it and say, the buyback maybe just be a support, because at the end of the day, maybe the promoter needs money. Maybe, for example, they are not able to deploy money and they want to squeeze the money out. Or, for example, they don't want to pay out extraordinary dividend or something because they don't have utility of that money, because it will be tax inefficient. I mean, so many reasons. But then you look and say, is it correct that this entire business is now growing? The business means not of that company overall. And you come and say, look, I'll look at other companies. Mr. Kumar Mangalam Birla, in his interview from Davos, said that there has not been a single case of a successful super app from India. So then you start thinking, that's actually true. Even Just Dial has not succeeded. So what is going to be the next catalyst of this company? So the exclusivity model sometimes will maybe challenged, because other people, after all, don't forget, Instagram is hosting a lot of people now. That Instagram is becoming a business channel. A lot of people are retailing through Instagram. WhatsApp is becoming a retail channel. A lot of people are retailing through WhatsApp. So you come and say, the model is changing and people are much more literate in terms of the use of mobiles than they were before. Then you take it your own call and say, or do I have other choices? If I am so much uncertain about it, why am I even taxing my mind? So swing trade is also a function of what you understand. If you decide to buy Ultratech because it has fallen a lot, and then you find that it goes up 30% in a month, and you don't believe the cement trade business for whatever reasons, of course it is valid. Another person says, no, look, if Mr. Kumar Mangalam Birla is spending 10,000 crore or whatever on setting up a paint business. Then after some days he announces, I'm going to set up an entire home solution business, and you come and say that there is a transformation happening at Grasim's level itself, and Grasim is the holding company of Ultratech, and therefore a lot of changes may benefit Ultratech in some way because platform may be created for them. Now that platform is very different from a B2B platform, because there the entire margin is yours, because you're only going to be selling your own product. You're the manufacturer. So you have to understand it from the perspective of the business, not from the perspective of the stock price.
Right, right, absolutely, sir. Okay, so I've got two more sectoral questions. One we briefly discussed the steel sector, and the other one is AMC and insurance companies.
Yeah, so I don't own insurance companies. I, in fact, wrote against insurance companies, and my exit from one of the top insurance companies was also picked up by Economic Times and converted into a story. And that insurance company has now, fallen 40% from that level. I don't believe in that for multiple reasons. First of all, a lot of people were hurt during COVID by business, and many of their business claims against insurance did not work because the insurance companies blamed it as an extraordinary act. I, as a lawyer, got so many matters where somebody said, my business was shut, my export order got cancelled because of XYZ reasons. I invoked insurance, they did blamed it on some cases where so many litigations went on, etc., etc. So what happens is you have shaken the confidence of somebody who thinks that for many years they paid an insurance premium and they got nothing. Second is that life insurance was very much connected to the market returns because there were not too many products. LIC was like a great product at one point of time because they would do something and they will give you some bonus. It was also a method of tax saving. That point, that saving amount was very good. Today, there are so many forms of tax saving. There are so many forms of capital market related things, including exchange traded funds, etc., that it is not the sole method of making money from the market increments. Thirdly, a lot of the things were spoiled by mis-selling because what happened is that some of the banks got greedy, their representatives, in fact, and they start because they have huge commissions upfront. So what would happen is they would mis-sell you insurance products which had very low yield because they would make more money on mis-selling those products. I myself, in fact, decided not to do business with one of the private banks because the manager came and mis-sold a product which is their flagship product, and I only this time waited for the redemption and said, to hell with you. After this, I'm never giving you business. So what happened is there are a lot of factors. Fourth, what is happening is the human life expectancy is going up. So when human life expend, what is the purpose of insurance? That my family should be taken care of if some thing happens to me. But overall, the human life expectancy is going up. Healthcare services are improving. I feel, and the premiums are getting more expensive. So I feel that it's not as if it's not a good sector. Some lot of people call it a sunrise sector, but I find that what, it has too much of competition coming in from so many sources. There have been so many companies that have propped up and made their products or come out with something else or the other, that I don't find, like, for example, tomorrow corporate, if I work in a job, the company may say that secure you from many perspective. I will give your future generations a job. I will give you this and that because they also want loyalty. Loyalty will have its price. So I am not a believer in that. I feel that if you have to play the financial inclusion theme, just some in substance of it is banks, because the bank will encompass everything. So why go and just restrict yourself to insurance?
Right, absolutely, sir. Absolutely. Thank you so much. And sir, Devina ji has also joined us. Thank you so much for
Oh,
joining
I'm
us.
very grateful because she is very smart enough and she'll answer some good questions. So I'll now also get to hear some lot of wisdom.
Yeah. Hi. Hi, ma'am. Can you hear us?
Yes, I can hear you.
Thank you so much for joining us, ma'am.
You're welcome.
Ma'am, I would love to have your take on to start with a broader take on the markets itself right now, ma'am.
Okay, so I have not been there for the whole of the session, so I don't know all of what you guys have discussed. So, broader take on the market. I always like to look at the long term and long term data. And one important thing in equity markets, all of us think that equity markets have higher risk, but they give higher return. That is what there in our mind. And we think in long term market में 14-15% बन जाता है, because that has been the long term return from the Indian market. If you see from the time Sensex started in 1979, we've had a compounding at little over 15%. So that we all know. So if you had started with 100 rupees in the Sensex, today it is 44,000 rupees. But then we said that again, we are very much data driven. So we said, like, what if you missed out 10 good days in the market? In 40 odd years, 10 days doesn't seem like a lot. And if you're just thinking about it, you would say it shouldn't matter much. But actually, if you miss out on the 10 best days of the market in 40 years, that 44,000 comes down to 15,000, two-thirds of your return gone. If you miss out on 30 good days, so which is less than average of 1 day a year, you are down to less than 4,000 rupees. So more than 90% of your return is gone. So, and the other thing which was there, that when do these up move days occur? And they don't occur during the mad bull phase ever. I mean, the only exception was the Harshad Mehta phase, because that was a rigged market. It was not a natural market. Other than that, all of them come when markets have fallen, when people are generally not feeling good about the markets. So now you don't know whether the markets have bottomed out or not, but now it is in a range where the risk is more in being out of the market than being in the market. Because if you're out of the market, if you miss out one or two of these days, you can never make it up. So that has been our advice, that whatever equity allocation you want out of your total asset pie, I mean, not from a 3 month or a 6 month perspective, but from a long term perspective, then it is time to be in the market. If your perspective is the shorter time, then please don't. Like, for example, a friend of mine who just sold an ancestral property, and he was saying that, maybe 6 months, 1 year later, I will find something that I want to buy. So should I give you my money to manage in the meantime? I said, please don't. Please put it in a bank fixed deposit where you are sure that after 6 months you will get your principal back, because visibility in equity markets of 6 months is not that great. But for a longer term, yes, this is a time to be in the market. Maybe not put in 100% of what you want to put in, but at least start putting it in 2 3 tranches over 2 3 months. So that is the take on the market.
Brilliant, ma'am. Thank you so much for sharing that with us, ma'am. Ma'am, we had also we had put up this session, and we had posted a tweet asking for questions, and we had received a question specifically for you as well. Two questions from Eklavya sir. So one was your take on the Ray Dalio's New World Order theory, and second, given that there is a lot of unnecessary criticism and hate on Chinese economy and the government in Western and Indian media, your opinion on Chinese economy in the next few decades.
Difficult to take a bet on the Chinese economy in the next few decades. Next few decades, who knows what happens to anything? But right now, of course, the Chinese. I mean, Chinese have managed their economy much better, because they started off with the same per capita income as us around 1980, and now they are 5 times bigger. So now there is no way you can even dream of catching up. And it's not as if that they're not growing anymore. So China is the two or three. So if you look at what's happening in China, there are two or three broad things. And some of it is contradictory also. One, they are very clear they want to be on the cutting edge of innovation in everything. Whether we all are familiar with the electric vehicle and battery thing, but they are there, like from neuroscience to semiconductors to pharma. Everywhere they want to be cutting edge in terms of innovation. They want to go head to head with the US. They are, whatever in terms of spending they need, subsidies they need, they are putting that in place. But they are also moving back to more state control, because essentially they don't want anyone getting too big for their boots. So this was very clear to us beginning of last year. I think it was February or something, when that Ant Financial, that Alibaba subsidiary, had to pull their IPO at the last minute because of the government. And immediately, soon after that, we sold all our China big tech names, because we said this is an unmodelable risk, that the government will wake up one day and do something to some company because they don't like that billionaire getting too big for their boots. So after that, all our we cut down at that point. China investments were mostly in below the radar companies, a footwear company here, a semiconductor company there. And we were underweight China, but now China is looking as one of the better markets in the world. So right now, we would have China weightage in our global portfolios and funds. In fact, other than India, China, and Mexico, to an extent Canada, those are the markets that are looking relatively good globally at the moment.
Brilliant. Thank you so much for that. Okay, I've got two, three questions around this, and basically, so this is kind of interesting. I want to ask both of you: is there an ideal portfolio sizing? So, of course, there is a debate around concentrated portfolios versus diversified. So, beyond that as well, do you think there is an ideal number of stocks that, as a retail investor, maybe that somewhere around that people should keep?
Okay, I will tell you what my thinking is. As a retail investor, you must have about at least 25 to 30 stocks. Uh, and two things. One, they should not be very concentrated in terms of sectors. If in 25 stocks you have eight banks and 10 FMCG companies, then you are not diversified. So you have to diversify reasonably across sectors also. And because out of these 25 odd stocks, some might become multi-baggers, but you don't know today which ones will become multi-baggers. I sometimes get these questions on Twitter and otherwise, that madam, you found this HDFC Bank 25 years ago at the split adjusted price of 3 rupees 80 paisa. So what is the next HDFC Bank that I can buy for my child, so that when she grows up she has that? I said nobody knows at the beginning. Even Aditya Puri didn't know that HDFC Bank would become what it did. Though I mean, even though that cover of our report then was the picture of a baby saying this is where it is, and we had Arnold Schwarzenegger that this is where it will be. But even so, who would have said that you couldn't see the entire journey then? So, bottom line being, some of them will be multi-baggers, some of them will also turn out to be duds. So, in fact, I tell people that as an investor, the simplest hack which will improve your returns is that when you buy a stock, always tell yourself that I may be wrong. Because the very best fund manager in the world will not be right 100% or even 90% of the time. If you are uh, if you are right 65% of the time, you are right up there. So when you buy a stock, always be ready that it may turn out to be a mistake. So that if you make that mental thing in the right at the beginning, it will hold you in very good stead. Because otherwise, as human beings, what happens is the stock falls 25%, 30%, and we keep finding reasons to convince ourselves why it still looks good. So be clinical about it, put your systems in place. In fact, I did a video recently on when you should sell a stock. So if you're obviously not doing this full time, so at the very least have trailing stop losses, that if a stock goes to 200 and let's say falls back to 150, you exit. Don't try to justify things. In fact, that is the reason why over time we have moved from a human being taking decisions to essentially the decisions getting triggered by the machine, especially the exit decisions. Entry, we still have more of a human overlay, but if a stop loss is triggered, we don't override it. So in your own portfolio also, be strict with that. And as I said, that if you choose with a system, with some study, hopefully some of those stocks are going to do very well and will compensate for whatever doesn't do well.
That's brilliant, man. Thank you so much for that. And you absolutely, like you said, keep the human factor trying to justify things. I think I personally have lost quite a few of my trades because of trying to justify those falls. And yeah, nothing better than that, man. Thank you so much for that. Safir sir, आपसे भी मैं I would like to ask the same question. If you can tell us, do you also have something in mind around the ideal number of portfolio sizing? How many stocks should be there, maybe in on the diversification versus concentration debate?
So my answer is that over a period of time, you know yourself better than anybody else knows you. After all, your ability of how you react to market drawdowns, up downs, how euphoric you get, how greedy you get, how risk averse you are, how risk prone you are, what is your source of capital, etc., is all known to you, your sources of income, etc. I'll just give you a hypothetical situation. There are people who come and tell you that with concentrated portfolios, we have touched the moon. But how many such people are there? There are very few. But on the other side, there are much more success stories of mutual funds and PMSs and others. Like what happens is a guy will tell you that I only own 10 stocks, but he will then tell you that I own 4 mutual funds. And in those 4 mutual funds, they own, 30 stocks each. So the question is that you have to develop, the most important point amongst this discussion is what Devina told you, that you cannot call yourself diversified by owning more stocks and by owning a particular sector and then saying that I'm diversified because I looked up the database and I bought all the banks and I had nothing else. So, for me personally, being diversified has worked beautifully. When I make an error, the cost of the error is low. When I do not make an error and it works for me, and as you say, the returns are high, the value of that particular stock keeps going up in my portfolio. A, because of price escalations. B, it also goes up because at higher conviction, I keep buying it more. So, if I started at say 1% and went to 10%, it's good enough for me. I will not go to the extent of making it 20-30%, knowing how much the world, sort of falters on certain things and other things that happen. Secondly, if the portfolio, this is back to that entire thing that I told you about, that 1 in 100 multi-baggers thing. Yet it will never happen. Hypothetically, I'm just talking. Suppose you have created a portfolio of 100 stocks just for mathematical reason with 1% weightage. It will not happen that in that entire process of study you will only have a very selective number of winners and many losers if your process was right. And how did I learn this? This I learned from my own experience, but later on I discussed this and Samir Oda put it up in a beautiful presentation where he showed that if you own 1/3 of the market and did not own 2/3 of the market, that 1/3 of the market that actually outperforms is enough to make you have a multi-bagger return compared. You would have beaten all the Sensex returns if you own the top 1/3 companies. The question is your process of selection of 1/3. You cannot overcrowd that by sector. You cannot overcrowd that by saying that I'm only looking at 52-week highs and making it, etc., etc. So and then there are others. I like to read about companies because I don't construe stock market returns as a function of a percentage return, which is actually the price of the stock versus where it goes. For me, there is a hidden cost there, which is the cost of knowledge. There's a cost of experience. I'm able to put that experience to many uses in my own life, which is beyond investing. Similarly, I'm able to put experience or mistakes that I make in my life into investing. So I construe that as a price of education, which is inbuilt, and I feel that diversified investors do. Also, I have no sleepless nights. Like if I'm sitting right now and you tell me that a company's come out with very bad results and the entire Twitter is spending time or other forum is spending time that the stock is going to open 10, 12, 15% down, I have no problems at all.
Can I just add a bit to what Safir just said, which is that, I mean, in any time, it is very likely that the very best performer will be somebody with a concentrated portfolio. I mean, look at the world's richest list. It is topped by people who hold only one stock each, whether it's Bill Gates or Jeff Bezos or Elon Musk. Essentially, they're all. But does that mean that it is a good strategy to hold only one stock or hold only five stocks? That is the, I mean, of course, they are also running the businesses, but leaving that aside for the moment. The point is this, that investing is a game of luck come skill. Everything in life is a game of luck come skill. I mean, chess is the closest thing you have to skill only. What diversification does is that it gets, and this you can mathematically prove, that it makes sure that your skill, whatever your skill level is, that gets translated into your results. It is like this: if you are tossing a coin, you know that it should come out heads 50% of the time. But if you toss it only 10 times, you might get 8 heads, you might get 2 heads, but you're unlikely to get 5 heads. But if you toss it 100 times, then it is likely to be close to that 50 number. So if you know that your process is such that you are going to be right X% of the time, by increasing the number of bets, which is essentially by diversifying, you can make sure you are closer to that with lower volatility. As for example, we manage funds, so we always say that 60% of what you pay us is for managing the risk, for reducing the drawdowns, and 40% is for managing the return. And if you do it properly, both come. So that is the important thing. And which is why I also, in fact, I retweeted an old article of mine today on why, when we ask whether we should follow successful investors, or for that matter, successful anyone or any company in life, why that is totally the wrong way to go about it. Because when you look at somebody who has, let us, made the richest investor list and say that I must follow that strategy which they have followed, that is the wrong question to ask. Because often what will happen is that the person who has reached there might have followed a very high risk strategy in which 90 or 99% of the people went out of business, but the people who were left made out like bandits. So it will totally mislead you. The question always has to be that of all the people who followed this strategy, how many won? And if you look at even businesses, many of them use this diversification technique. If you read about the history of Amazon, for example, we look at it as this linear story, ki ye kiya, ye kiya, ye kiya, and this is where it reached. But if you read the history of Amazon, they tried so many things, and so many things did not work. And but a few things did work. So always think through. And this thing, what I'm talking about, is called survivorship bias, which many of you may be familiar with. That whenever you look at data, look at all the data, everybody who was there at that point in time. I mean, I hear all these stories that some so and so's father or grandmother bought Hindustan Lever or IDFC Bank or this, and it's compounded so many times. I wish my parents had started investing. But your parents, even if they had started investing, they might be holding uh, Hindustan Motors or Balarpur Industries, and all those companies which were in the, or Sindhya Steamship, which were all the original Sensex companies and had been around decades then. Or recently, and this is a real life thing, a friend said that my mother has this portfolio which she hasn't looked at in 20 years, and here it is, and see what you can do. And that had all these NEPC, Micron, and DSQ software, and all of the hits of the early 2000s. So, I mean, always in life, look at that whatever data you are starting with has all the companies, all the stocks, or whatever you are looking at, which would have existed at that point in time, not the ones which have done well and therefore are making the headlines today. So, have rigor in your process.
Yeah, and one thing I wanted to add to this is that I don't consider the owner of a business owning his own stock as a portfolio investor. He's a business investor, so therefore, as an example, Steve Jobs was not buying Apple shares when he was heading Apple. And even now, Bill Gates' largest investment was in Berkshire Hathaway. So, what happens is if the insider doesn't know so much, and see, it's very different when he's running it. Like if you say Mr. Ambani owns his own business or XYZ, then they are owning their business and they're also they're thinking of mitigating risk of, for example, oil with Geo with retail, with something else, etc., etc. So that's one thing. Second, so I don't construe the ownership of an individual in his own company which he's running, which is his bread and like tomorrow. Like by that logic, if you ask me, you'll say that Safir, what is your investment? I'll say one is equity and one is my law firm. Then you'll say you're very concentrated because my stake in my law firm is very important for me and it's high. But that's not how I construe it. I mean, that my law firm also will not concentrate on one client or one jurisdiction. They'll try to mitigate. So everybody has to see it from that perspective. See, I've actually deliberated on this a lot. It used to be one of my favorite topic, concentration, diversification. And I looked at the data and I said, all the rich people in the world, like Devina saying, who got rich, but they were actually business owners. Their business enriched them.
See, even as an investor, you can get rich owning a handful of stocks. It is not that it is impossible, but that's a game of luck. It is not a game of skill. So, which is why many successful investors you will find have made all their money in one or two stocks. But that, as I said, is not predictable, not consistent. Uh, I mean, that's the way, for example, a lot of my personal money would have been made, but I never wanted to take anybody else's money and manage it that way till I had a system where there is some replicability, some consistency, some predictability.
Right. That's brilliant. It was so interesting to hear both of your views, and this was amazing. Okay, I have another very interesting question from Pragun sir. How much margin of safety should be kept for big businesses with good market share, but low revenue growth and mediocre profit growth? Should you consider them for your portfolio considering they are trading at less than 12 PE? So this I kind of again want to take it on a broader context. So for instance, Safar, we also discussed an example of ITC that at one point people were not very happy with ITC, but then now it is, despite being one of the giants, it's kind of running away like anything. So, what is your both of you panel tonight? What is your view on such businesses?
So, view on, sorry, what businesses?
So, big businesses with good market share but low revenue growth and mediocre profit growth.
No, but if the business growth, see, again, you're talking about growth. Let's assume you're a low growth. What do you call as a low growth? Suppose the growth is say 10%. You'll call it a low growth, you'll call it high growth. Question is also what is the market valuing that growth at? If the market is not even prepared, so what happens is if the market expects, say, a 2% growth, like what has happened with Hindustan Lever's result? All of a sudden, people said we did not expect this volume growth. So if you look at it from that perspective, it is also a mismatch of expectations, and it is also commensurate to a company's ability. But for example, if you tell me that a company is going to grow low, it's a big company. It is like let's take an example of Grasim only. Grasim may have a lot of intrinsic value, but it reports low growth numbers. So the market doesn't really care beyond a certain point. So growth is a function of, the value is a function of what is the proponent on the other side. Is it an asset value? Is it a growth value? Is it what is the value that you're talking about? So the other thing is that this is my personal view that although ITC may have been the best performer, it doesn't mean that it has to be the best performer after this. Sometimes inefficiencies of the market are caught on, and that inefficiency may have been caught on in its case. Like for many years, Hindustan Unilever had no return, then all of a sudden it had the best years of its return. And then it may, I'm not talking about Hindustan Lever, but there may be other consumer companies right now that may enter into a stagnation phase over the next few years. That's Or it may enter into relative market underperformance phase. Like Infosys also has gone through this cycle, and so many companies have gone through the cycle. So don't be fixated only on this fact that it's a big company and low rate, big company and high rate. Like there are big companies that all of a sudden report good growth rates also because they do something interesting or some catalyst moves in their way. So I can't be looking at a company per se. I have to look at where the company's value is. Is it proportional to the market price, and is there an opportunity to grow? Similarly, for example, people fall into dividend traps. They look at the company and they say yield of this company is so much, therefore it is good. But then you're comparing it to fixed deposits, and in that case look at it from a fixed deposit comparison. Don't compare it to the stock market, because if you do, then you'll come and complain that these companies, for example an OMC, has not given me returns, because every year when the dividend is adjusted, it will adjust its value to that extent. Or even if it doesn't exist, it will not commence. It is only getting adjusted to the value of the dividend. I mean, it's only reacting to the dividend. See, for example, there is an MNC stock on the market right now in the pharma sector that has been doling out extraordinary dividends for the last three consecutive times. The dividend payout is huge. So you can get carried away, but and say that this is great. This company has become very good. This kind, the cash flows are very good. But no, it's not the cash flows. They're distributing the cash flows. they are probably telling you that India business does not have value for incremental capital. So we are returning the money essentially to the parent. You happen to be holding the shares, and because under law you are obligated to get the dividend, so you're also getting it. But they have no use for that capital. Castrol India, as an example, another example, reduced the face value of the shares and returned you back 5 rupees. Where did the stock go? It's a big company, no, but what is the growth? So you have to look at it from the cycle of the business itself.
Right. Absolutely, sir. Absolutely. Ma'am, can I have your take
Yeah.
as well, please?
Yeah, I mean, what Safir was saying was so important that people think that there's something called all weather stocks that no matter what happens to the market, they will do well. However, as he pointed out, from Hindustan Lever to Infosys, every stock, no matter how good the company, has gone through ups and downs, has gone through long periods of underperformance, if not actual fall. Or oftentimes, what happens in larger companies is that the stock goes nowhere for years, and that is how the adjustment happens through time rather than. So, always look at data. This is the important thing, that always look at data. Don't get carried away by narratives or stories. As human beings, we all love stories. I mean, that is what makes us human. In fact, stories is the one thing that is common across all civilizations. So we all love these stories, but always, whenever you hear a story about a company, go back as many years as possible and see whether it's borne out by the financials and also by the stock price movements. And also, often people only talk in terms of growth. This is the other thing. Please also look at things beyond the income statement. This is another point that I keep hammering, that people only look at any analysis of a company stops at sales ka ye hua, this happened to margins, that happened to earnings growth. Please look at the balance sheet. Please look at the cash flows. In particular, look at return on capital employed, return on equity, look at cash flows before and after capex, see trends in those. That is where you see the turning points. Like, for example, people ask us that how did you make this call on Amazon at $15, which is a split adjusted now 75 cents, when everybody, and this means every firm on Wall Street had a sell and saying that the company is going bust, and we had a strong buy. We're in a minority of one. And there was only one reason, because in the quarter prior to that, which was the last quarter of 2000, it had made huge cash flows. It had made, I forget, I think 220 or $240 million of cash flows, whereas in the corresponding period in the previous year, the cash flow was negative. The first time the company has made this kind of cash flow, and you're saying the company is going bust, that is the whole point, that many times even so-called large names don't do the basics. So if you are seriously analyzing a company, don't just look at growth. That is the bottom line. Not just growth and margins. Go beyond, look at what's happening on the balance sheet, what's happening in the cash flows. If you're not familiar with accounting and finance, then educate yourself if you want to do it yourself.
Right. That's brilliantly put, ma'am. Thank you so much for that. I think we've covered quite a few questions, and some of the questions are being repeated. I would request the audiences. We have had a long session. We'll release a recording of this session immediately after it's over, so you can listen to it for the parts that you've missed. But there's one more question that is kind of yet not addressed. So that is, in the coming years, there is a fight that is kind of going on between pure electric vehicles and hybrid electric vehicles. So, in case in that sector, if you have either of our panel has a view, we'd love to hear that.
See, I will answer it from a legal perspective more. And what I mean by legal perspective is not as a lawyer, but as a person who works on technology protection for companies. The biggest companies in this sector themselves don't know. They are somebody is working on a hydrogen car, somebody is working on a hybrid model, somebody is Maruti believes that the future lies in CNG, fourth person believes. So it's not, what is happening is, in a way, it is like a dipstick for them also. So because what is happening is it's like, for example, a company may be very proficient with its e-vehicle when it comes to, for example, a charging vehicle, but they may be skeptical about infrastructure in India. There may be other companies that basically believe, for example, that India may have a lot of solar supply, but solar vehicles will not work in India because of the ability of the vehicle to power, because it cannot be going at a speed of 40 kilometers per hour. So it is not known right now. It is not as if it's a tested model right now. There are price considerations here. There are price considerations of technology that have to be sorted out, which are not which are not so clear. So it is, when the CNG came and people put cylinders behind their cars, many people that time used to say that this how ugly this is, it will not work. People were even putting, it was looking very gaudy, etc. They said it will not work, but it then worked to whatever extent it did. So it's a model, according to me and according to what I study, it's a model yet to be tested. That's why I said it is very difficult at this stage to bet on which company in the sector will lead in automobiles. And because we are not sure, I say it is easier to deal with companies that cater to all these companies. Like this is which is why we, for example, bought auto ancillaries. For example, I read a lot of what Bosch says, just as a general example. The only disadvantage is Bosch has got listed and unlisted companies both in India, but they talk a lot about mobility and what the future is going to be. So you have to read on the reports of a lot of people. Like, for example, ABB talks so much about smart cities, but then in reality, smart cities, whether it comes, does not come, what are the state considerations, etc. We talk so much about water purification projects. What has happened to water purification? Where are those companies that are purifying water? It's a very difficult call to take. Now, if you say that a company makes a pump by virtue of which the water is sort of drained out, you'll say this is easy. It can work in water, it can work for purification, it will work in your home, it will work in the fields, it will work in the thing. So look what's happened. All the pump companies are going up. Water purification companies are still sitting there.
Right. Absolutely. Absolutely, sir. Thank you so much for that. This was a very interesting session, but before we close, I would love to ask both of you to, can we have maybe a parting message, a parting advice, or a concluding remark, something for us that for all of us that we are listening here today from both of our guests.
So ladies first. So Devina obviously will get first rights.
Okay. So, in terms of advice, two basic things. One is reading. I mean, when I joined earlier, I listened to a bit of talk about books and all, and that would be my number one advice, that unless you feed your mind, nothing is going to come out. And it is very good investment, because very often it is someone's lifetime learnings that you can just get in a uh, sort of distilled form for a few hundred rupees. I don't think there is any better bargain in the world. I mean, for example, I'm just reading this book on demographics by Amlan Roy. Now, this is somebody who spent a lifetime studying demographics and how it impacts economies, how it impacts companies. And by the time I finish it, I get what he has learned in a lifetime. Reading another very interesting book on evolutionary ideas about how the solution to any problem has, I mean, every problem, in a sense, in a general principle sense, has been solved somewhere, either by a person or a company or even in nature. So I, I always say it opens windows in your mind. When you read, so many other ideas pop into your head. So if you seriously want, not just in investing, but to make something of your life, then reading is all important. Otherwise, you can have a job which pays the bills, and you can go through life smoothly and spend the rest of your time watching OTT shows or whatever. But if you really want to be a learner, to move ahead in life, whether in a worldly sense or otherwise, then reading is important. In terms of investing or anything to do with the markets, my one mantra is be data driven. Close your mind to stories unless they are supported by data. So whether it's macro data, company data, industry data, look at data, go back as far back as you can, and test all your assumptions. Don't go in with a made up mind that this is how things are and look for things to support it. Charles Darwin used to say that whenever I have a theory about something or a hypothesis about something, if I come across anything that contradicts it, I write it down quickly because otherwise, as a human being, the tendency is to filter it out. So, all the best. So, these would be my two top things: reading and be data driven.
Thank you so much for that, ma'am.
Yeah, so obviously I am a big proponent of reading, so I totally endorse that. And ironically, I use the same example when I told you that a few hundred rupee books is basically a blessing in disguise. So there is no stopping. I even extended to the fact that a 4 rupee newspaper or a 5 or 10 rupee newspaper also gives you so much if you want to find it. You should concentrate on find reading a lot. It will also improve you as a person. It will improve your ability to speak, your confidence level when you are in possession of knowledge. It will improve the chances of your decision making when you have the it sort of builds on your conviction. The second learning that I have is, and this my team tells me that my team tells me that you win so many awards, you've now started writing book and whatever XYZ. What happens? I said, the date that awards is given, that celebration continues that day. But next morning, I have to become a beginner, because that my past is not going to write my future. My past may carry some goodwill for me, but I can always fall from the top of a mountain. So my one of my advice is that every time when you have accomplished something, relish it. You must celebrate it. You must give that feeling to yourself that you have accomplished it. But next day, start off with a mindset that now I have to again be a learner. I have to behave like a startup in a sense, and I have to redo a lot of my things, and that creates a innate hunger in you. That innate hunger, for example, I look at my portfolio and I ask myself, how can I improve it? Now in reality, you don't improve your portfolio every day. So sometimes you do nothing to improve it, and that doing nothing is itself a learning. That means you do not change lanes, and you do not chase those the stocks that are up that day, or some news that is coming out where everybody is buying. And then when you make a mistake, you bless yourself and say that I also celebrate my mistakes. By the way, I tell my team that when my portfolio goes down, I'm just giving you a market related example. It's the same thing in my legal, that if I make a mistake, then we must celebrate the mistake. So what do you do in terms of celebration? You say, I'm going to convert it into a learning. The celebration is of the learning, not of the mistake. It's of the learning, and say that I got away from a mistake and I survived. I did. My life is still here and I've survived, and I have the ability to build upon it. So let me now celebrate it so that I do not make this mistake the second time. And that, according to me, are my two learnings. And my total gratitude to all of you for having stayed away so late. It's 11:34 in India, and to have given all your love and affection and all your feedback. Please do share your feedback, because people who host these events, I'm not a host today, I've just been made a co-host because I was inviting other people to speak, but otherwise people who host them get very good feedback on the kind of question they should be directed. Instead of asking me, should I buy XYZ stock, what will happen? You'll buy it, you'll make some 20% return, and so what? Try and become a better thinker. It will, the rest of your life, you will not need some of us. You will become very enriched in your own experiences, and you will do very well in life if you learn well. Thank you and good night.
That's brilliantly put, sir. Thank you so much, first of all, making out time for us, and Devina ma'am for joining us and enlightening us with so much wisdom, so much gems of knowledge, and so much advice. So, this session has been, Safri sir also kind of summed it up in the same way. This was not about giving a man a fish, but more about teaching a man how to fish. So this was amazing. This was a brilliant insights, and of course, our beautiful audience tonight. There are so many brilliant questions, and again, thank you so much for your patience for staying for so late with us.
Or not just men, women too. Issue.
Yes,
Not again.
I was about to say that it's kind of outdated now, and
One
it's
of the
unfortunate.
books I have read recently, which made a big impact on me, is called Invisible Women, which is that the whole
Yeah.
world is defined and designed with a man as the default human being, and causes everything from causing women to die more in car crashes or of heart attacks, because everything is tested on and designed for men. So sorry for
Yeah. No,
interrupting
no,
on
that's
that, but
no, man.
I cannot stop myself.
No,
Let
that's
him.
great. That's actually it's very good thing. I was about to say, but I didn't say it, but I wanted to say that. In fact, that reminds me. Today itself in the morning, I was thinking there is a very nice poem by Rudyard Kipling called "If," and it ends with such a nice para, but at the end it goes astray. The last lines are, if you can fill the unforgiving minute with 60 seconds worth of distance run, yours is the earth and everything is that is in it. And what's more, you'll be a man, my son. And it's so unfortunate that it ends that way because the rest of it is so beautiful. So thank you
Yeah,
so
but
much for interrupting me on that.
that was you know more than a century ago. So we should not
Yeah,
should not at least
yeah,
do it now.
yeah.
And
No, but
thank
thank you
you
so much
very
for
much,
interrupting me.
and thanks Safir also for inviting me in, and thank you all for
Yeah.
listening.
Thank you so much. Thank you so much, our guests, and thank you so much, our audience. I really hope you have a really good weekend and a very profitable week coming Monday. Good night, everybody. Bye bye.